My name is Eurusd and Audusd, and I couldn't be more excited to be your instructor for this course. But before we dive into the world of trading, let me tell you a little bit about my story. Growing up in a poor country wasn't easy. My parents had to work hard to provide for our family, but despite all the struggles we had, I knew deep inside of me that I would be successful one day. That's why I'm so passionate about trading. For me, trading is so much more than just making money. It's about taking control of your life and creating a better future for yourself. And that's exactly what I want to help you do. So in this class, I'm going to share with you the skill set that completely changed my life. I will show you how I became a successful Forex day trader and how you can do the same. I could show you all the rewards that come with being a successful trader, like the wealth, cars, party, luxury trips, but instead, I want to focus on the process of getting you there. Most courses will only teach you the basics of a strategy, but after failing so many times, I know that having a solid trading plan is the only way for you to get consistently profitable. So that's why I'll be sharing with you our entire trading strategy, including every single setup and entry method we use for our trades. This is the first time that I'm sharing my personal trading strategy, and I can assure you that you won't find a comparable level of detail in any other course out there. You will have a checklist and a whole detailed plan written by me. In the new trading club, you'll find a community of professional traders with a shared mindset and all the resources you need to become a full-time trader. If you have taken other courses before, I know that you reached a point where you didn't know how to react in a certain trading situation. And when you asked for help, you may have been told to follow your plan. But as a beginner, it's unrealistic to expect you to have your own trading plan without first learning the concepts and gaining experience. That's why our course is designed to not only teach you the foundation of trading, but also provide you with a ready-to-trade plan. It took me years of chart analysis to learn what I know. And while it can be challenging to learn on your own, I believe it has given me a unique perspective that I can now pass on to you. Being a successful trader is not just about hard skills. I once heard a phrase that really resonated with me. It said, "To be a better trader, you need to become a better person." It took me a while to fully understand what this means, but I'll do my best to teach you this mindset as well. Trading can be one of the most challenging careers out there, so it's my job to guide you through this journey. In this course, I'll be teaching you how to read the market and understand the factors that separate successful traders from those who struggle. We will also cover the fundamentals of smart trading, technical analysis, multi-timeframe reading, and chart mapping. You will also learn about the mindset of a successful trader and how to use it in live market conditions. As you watch the videos, you will see that each topic builds on the last to create a solid foundation for your trading. But remember, trading is more than just showing up at your computer every day. It also involves a daily dedication to self-improvement, including journaling your trades, maintaining a healthy lifestyle, and practicing mindfulness. You should start by asking yourself, how is your diet? Are you getting enough sleep every day? Do you meditate before trading? So keep this in mind. Every detail plays a role in your success as a trader. So you should start planning the changes you need to make as soon as possible. Our goal is to provide you with all the tools you need for success, whether that means helping you with clarity on your chart analysis or supporting you with mindset advice. By the end of the course, you should have a comprehensive understanding of day trading and be ready to execute trades following our step-by-step plan. The course will be broken down into different video sections, so I recommend you watching the videos as much as possible. The more you practice, the better you understand how to start doing your own analysis. Trading can be very lonely and boring sometimes. So believe it or not, a lot of losing trades are due to boredom. So make sure to join our club and start engaging with the community. One thing you need to remember is that trading is more complex than we think, and you can't expect to learn everything overnight. My goal with this course was to condense everything that I've learned over the years into short, easy to understand videos. There are plenty of resources out there that make trading seem overly complicated, but I believe in getting you started with live trading as soon as possible. That being said, discipline and practice are essential for that to happen. We will focus on analyzing the market daily and following our trading plan as consistently as possible. So remember, repetition is key. This course is suitable for both advanced beginners and experienced traders. If you are new to Forex, don't worry. We'll provide you with some resources to help you learn the basics of Forex, such as pips, major trading pairs, how to place a trade, and some other basic stuff. Our main focus will be on the more advanced concepts. That will set you apart as a trader. Trading can be very rewarding, but is also mentally and emotionally challenging. I need you to step into this learning phase with the right mindset. If you're the type of person who likes to take shortcuts and expect things to be handed to you, this course may not be for you. Trading requires hard work and discipline, but the reward for that hard work is the satisfaction of achieving your goals and the freedom that comes with financial independence. After you complete the videos, you will have a better understanding of how to start trading, and you will be one step closer to your financial and time freedom. But you have to remember, the key to success is practice and discipline. So what's up? I'm Marcos de Andrade, and this is New Trading Club. Hi, my name is Marcos de Andrade, and I'm a full-time Forex trader. For as long as I can remember, I have been disciplined in everything I do, and trading is no exception. If you already follow me on my social media, you have probably seen me sharing my long hours of trading. And talking about trading, let me tell you, I didn't become a Forex trader overnight. I was born in Brazil and moved to the US when I was 15. Being an immigrant in a new country, not speaking the language, and having to work harder than most people to survive has made me a strong person. Sometimes I hear people say that trading is risky, but seeing my parents sell everything they had to buy tickets to come to a foreign country is what I truly call taking a risk. The fun fact is that I don't have anyone with a business in my family, but I have always been interested in finding new ways to make money. For as long as I can remember, I have been good at teaching myself new skills like playing drums and the guitar, building websites, photography, even video editing. I started my own business when I was 19, and since then, I have never worked for anyone else. I believe that's why I'm so passionate about teaching others how to be self-sufficient and be their own boss. Everything in my life has been hard to achieve, but my trading journey has been one of the hardest, but also the most rewarding experience of my life. Looking back now, I can't believe how much misinformation there is online about trading. It's possible to learn how to trade on your own, but it would take you long hours of searching and getting through the noise to find the right information. I can say from experience that learning to trade by yourself can take from 1 to 3 years depending on how much time you put in. I really wish that I found a solid course when I started, because that would have saved me years of work. If you're watching this now, you made the decision to take control of your financial future and learn how to trade. I would say there are 2 categories you could fall into. If you are in the number 1, you're very lucky to have found a place where you can learn a solid strategy from the start. And if you are in the number 2, you have a similar experience as I did. You spent months or even years trying unsuccessful strategies, and you're probably a very determined person to even continue to learn how to trade. Either way, I genuinely believe that I can help you become a great trader. If you ask for my advice for someone just starting out, I would say to not focus on making money right away. Yes, that's the overall goal of any business venture, but when you attach emotions to money, it has the power to make you happy or sad. One day you make money, you're happy, you lose money, and you're sad. That's a recipe for failure, especially in trading. So instead, focus on the bigger picture, the freedom, flexibility, and creating a dream life. Don't worry about money. You'll see when you start achieving your goals, the material rewards will come naturally. So that's why the main goal of our club is to focus on the process and not the outcome. So here we go. In our first video, we will briefly introduce you to our course and how we trade the $1 trillion Forex market. The Forex market is the most liquid market in the world, with trillions of dollars traded daily. This is a major advantage over stock trading, where liquidity can be a problem, especially when trying to enter or exit a trade. In the stock market, you may encounter situations where there isn't enough liquidity to fill your orders, especially when shorting a stock. Luckily, this is not an issue in the Forex market. And another advantage of Forex trading is that you don't have to worry about overnight gaps in price. In the stock market, it's not uncommon for there to be massive gaps in price because of after-hours orders, which can be dangerous if you have a position open with a small stop. And guess what? If you have one of those orders open in the stock market, they won't get filled where you want it, and you could probably lose your whole account. I have also traded stocks, and this is something that happens every day. Finding the right strategy can be a challenge, especially when you're just starting out. There's a lot of misinformation online, and it can be hard to know if a particular strategy is profitable or not. It took me years to find a strategy that made sense. Our strategy is based on simple price action, which is driven by supply and demand. This is basic economics. Whenever there's high demand for something, the price goes up, and when there's a lot of supply, the price goes down. By eliminating unnecessary indicators and focusing on just clean price action, you can develop a more accurate understanding of the market and make better trading decisions. I still remember today when I used to think that trading was all rich people's stuff. You know, like buying houses, spending crazy amounts of money. That's exactly what society wants you to believe. That you need to stay in your lane and stay safe. Go to school, get a job, and retire poor when you can't work for us anymore. The fact that I was never a math guy also made everything related to money even more out of reach. As some of you may already know, the name Neo for our training club comes from the movie Matrix, because I believe we need to be reminded daily that we cannot settle for normality. The normality we see in the world is that everything that is abundant is out of reach, and you should live your life safely within the parameters of the matrix. There are many ways to escape this normality, but I'm sure that anyone can benefit from learning how to professionally trade, even if you do it part-time. It's one of the best ways to compound your money. So why wouldn't you do it? You cannot trust the government or the banks. You probably know that the money is not real, and the digits you see in your account are also not real. Our purpose here is not to go into a tangent on conspiracy theories about the matrix. The name Neo is your daily reminder of why you do what you do and who you do it for. The Neo Trading Club is a group of professional individuals who saw in trading an escape from this normality that's forced on us. We refuse to live mediocre lives and have a job that we detest. We believe that you need to take life into your own hands if you want financial, location, and time freedom. The best way for me to describe our trading strategy is precision. So much precision that you will know exactly where the big banks have placed their massive orders to make the move you see on the charts. Our way of trading truly opened my eyes to understand how the market moves and how it's manipulated to make the regular guy fail. With our strategy, you only need to focus on a single pair every day to get consistent results. You also understand how important it is to have risk management in place. Our minimum risk reward is 5-to-1. When you start seeing that the normal for other traders is to have 2-to-1 risk reward trades, you will see how powerful our trading strategy is. So now that you have learned about the purpose and approach of the Neo Trading Club, it's time to dive into the details of our precision trading strategy. Are you ready to take control of your financial freedom? Welcome to Neo Trading Academy. Our lessons are designed to be easy to understand, with each topic covered in short video format. We understand that it can be overwhelming to take in a lot of information at once, so our approach is to break it down into manageable chunks. As Marcus Tullius Cicero said, "If I had more time, I would have written a shorter letter." We believe that brevity is key when it comes to learning and understanding new concepts. We want to make your learning experience as efficient and effective as possible by presenting our lessons in short video formats. You can expect our lessons to be organized by topic, with each video focusing on a specific aspect of trading. Whether you are a complete beginner or have some experience in trading, our lessons will provide you with the knowledge and skills you need to become a successful trader. Now that you have learned everything about our trading club, let's start building the foundation of our trading knowledge. But before you get too excited to start placing trades, it's important to remember that patience is key in this first step of the process. In trading, the pursuit of speed and instant rewards is often what leads to failure. In fact, it's estimated that up to 90% of retail traders lose money. So that's where I come in. My goal is to help you avoid the common mistake that beginners make so you can become profitable from the start. When it comes to analyzing the market, there are two primary approaches: fundamental analysis and technical analysis. This can be a controversial topic in the Forex community, as some people claim that one approach is more important than the other. Let's take a closer look at each type of analysis. Fundamental analysis involves studying economic data, news headlines, and other factors to determine the strength of a country's currency. This includes elements such as monetary policy, retail sales, unemployment rate, inflation, gross domestic product or GDP, interest rates, and others. While fundamental analysis can be very useful, it can also be quite complex and require a deep understanding of macroeconomics and geopolitical events. Additionally, the software and sources of information needed for this type of analysis can be expensive and out of reach for many retail traders. At Neo Trading Club, we use technical analysis to study price action. Technical analysis involves using historical prices to analyze the current movement of a currency. The main idea behind technical analysis is that history repeats itself, and the same is true for market movements. We like to say that technical analysis is the mirror of fundamental analysis. Whatever is happening in relation to news and economical data of a country's currency is instantly printed in the charts. As technical traders, our goal is not to predict the market, but rather to gather clues from the charts based on past events in order to forecast possible movements in price. A trader is like a weatherman. For example, you can have super expensive tools that help you to predict if it's going to rain, or you can simply create some mechanical ways to forecast the weather, like looking at clouds, noticing the changes in wind direction, etc. And guess what? Both the weatherman with all the high-end equipment and you with your own creative techniques can be wrong many times. We don't need to be right 100% of the time to keep our job, and in our case, to potentially make a lot of money. While we primarily rely on technical analysis, it's important to be aware of major events that may impact the market. These events, known as high-impact news, can bring volatility and uncertainty to the market. Since we trade based on highly probable events, we avoid trading around high-impact news, as it can be risky and lead to slippage. And just as FYI, slippage simply means that your broker won't fill your order at the price you wanted because of the volatility of the market. So some examples of high impact news include CPI news, the Consumer Price Index, unemployment rate releases or NFP, which is the non-farm payrolls, and political speeches. You can find more information about these events on websites like forexfactory.com or TradingView. Both websites have calendars that can be filtered by currency pair and type of event. As you start getting more familiar with the strategies, you will start switching how you view the charts to look at them like the professionals do. To understand this concept better, think of the charts as a game of chess. As you become more skilled at the game and start to recognize patterns, you will be able to play both sides of the board. Instead of trying to predict what the market will do, you will react to each scenario as it happens in real time. This means that you're not biased toward any particular direction, but rather you are simply looking at what the market's next move might be. To reach this level, it's important to study technical analysis, but also understand a trader's mindset. One great resource to understand the uniqueness of the market is to read the book Trading in the Zone. It will help you shift your mindset to this more experienced approach. As a new trader, it can be difficult to understand how experienced traders are able to analyze complex graphs. So in this section, we'll learn about market structure, which is the foundation for everything else. We will also cover other important topics, including different types of structures, how to map them, and concepts like strong and weak points in the market. Before diving into the advanced concepts of trading, it's important to have a solid understanding of market structure. So in this section, I'll provide a quick overview of the basics of the market structure to help set the foundation for further learning. When you open a blank chart, you'll see candles moving up and down. These movements are the result of supply and demand in the market. As buyers and sellers engage in trades, the charts will reflect the changes in price. These moves of price create historical data that can be analyzed to identify trends and patterns for trading purposes. When it comes to the Forex market, understanding the direction of price movement over time is crucial. This is where trends come in. In the Forex market, we have two types of trends, bullish and bearish. A bullish trend, also known as an uptrend, is characterized by a series of higher highs and higher lows. This means that over time, the price for a certain currency has been rising. When the market is in a bullish trend, it's considered to be in a state of buying. On the other hand, a bearish trend, also known as a downtrend, is represented by a series of lower lows and lower highs. This means that the currency price has been falling. When the market is in a bearish trend, it's considered to be in a state of selling. So being able to recognize these trends is important for understanding the Forex market and will help in later concepts like structure mapping and analyzing multi-time frames. The Forex market is constantly moving with prices pushing and pulling back. It's important to understand that these movements will continue until it fails. In this lesson, we'll take a closer look at how to spot these movements in price and what happens when a price movement fails to achieve its goal. First, let's define the terms. Swing highs and lows are the large highest and lowest point of a movement. These points are created when a structure is broken, which we refer to as a break of structure or a boss. We determine that a structure has been broken when a candle body closes above the recent high in the particular time frame we are using. For example, in a bullish trend, we have a push followed by a pullback and then another push to break the recent high of that movement. The low where the push originated is the swing low, and the top of the push is the swing high of the movement. After the pullback is finished and we continue the movement to break the recent high, the lowest point of the pullback will be the swing low, and we'll wait for the next pullback to determine the next swing high. It's important to note that we use this mapping to understand where we are in the market and where we should expect price to go next. This helps us avoid getting caught on the wrong side of the market. In addition to understanding market structure and how it moves by making new highs and lows, it's also important to understand the job of each movement and the expected order flow. To better understand this, we use two terms, strong or protected points and weak or targeted points. So let's take a look at the charts. In a bullish market trend, the job of the strong low is to break the weak high. And in a bearish trend, the strong high's job is to break the weak low. As you can see, when there's a push and a break of structure, we expect that when price pulls back, the strong point of the move will be protected, allowing price to continue breaking the weak point. As mentioned earlier, we should expect the order flow to continue until it fails. If the strong point fails to break the weak point, instead returns to break what was the strong point before, we can switch our bias accordingly. The point where price failed to break is now our strong point, and we should expect price to pull back and continue the new order flow. This concept, although simple, is crucial to understand how price is moving and reacting to structure. We will be using all these confluences, such as market structure, breaks of structure, and fail points, to build a high probability analysis to know where price will head next. This element will also be part of our trading plan and will be covered in more detail in future lessons. Okay, by now you should understand how we map the swing points of the structure, but as we know, the market is complex. So in this lesson, we'll look how to spot these complex structures. First, let's learn about the types of structures and how to use them in the charts. In our strategy, we mainly use three types of structures: swing, internal, and fractal. Swing movements are the largest movements you see on the charts. We map these movements after a confirmed break of structure with a candle body close. The internal structure are the smaller moves that happen inside of the swing structure. We also map these movements after a confirmed break of structure with a candle body close, which we call IBOSS. We use internal structure mapping to guide us through the small movements of the market, which typically create the big movements on the chart. Fractal structure is the smallest move we see on the charts. There are small pauses or pullbacks of price, which are usually just a reaction to a not so strong resistance before continuing with the order flow. Unlike swing and internal structures in which we use a candle body close to confirm a break, for a fractal break, we only need a wick break. In the charts, we see that price moves by each candle breaking the next candle. Since for a fractal structure, we use candle wicks as confirmation of a break, anytime that a candle does not break the next candle by at least a micro pip, we see it as a fractal structure. It's easier to spot fractals when there's a clear retracement, but you need to pay attention when a candle has equal highs. An equal high is also not considered a break and is therefore part of a fractal structure. It's important to note that the color of the candle doesn't dictate if there's a fractal break or not. All that matters is if a candle breaks the next candle or not, independent of if it's a bullish or bearish candle. To help visualize the market structure better, there are two indicators I recommend. One is the inside bar, which I leave it on all the time. And the second is the equal highs and lows indicators, which sometimes I use on the 1 minute time frame for entries. This indicator can be useful if you're just starting out. So let me show you how to install them. Alright guys, so let me quickly show you guys how to add the two indicators I mentioned on your charts. So first, when you open your chart on TradingView, you go to indicators and then you type inside bar and you see this one called inside by bars by CMA. So when you click on them, you're automatically add to the chart. So they come as default with these colors here. But I already had the indicator, so I'm just gonna turn it on. Yeah, I kept it simple with just like orange, and you can add these shapes here. So, to make it more visible for the inside bars, and I make it visible for all the time frames. And the second one, same. You could go to equal highs and lows, and it should be this first one here. Yeah, like the same. It comes with a default, but for this one I just keep them on the 1 minute time frame. Let me see here. But you can see like every time there's a equal high, then you're gonna see like the indicator showing you. Yeah, as you can see. So these are the ones that I use, And I leave this off for most of the times, and sometimes when I'm gonna enter on the 1 minute, I just turn it on. But I try to keep it off just to make the charts look a little more clean. All right, guys. Another tool I use a lot is the OHLC values. So when you hover with the pointer on a candle, it tells you the price value of that candle, like the highest price, close price, open price, etc. This tool is very useful, especially if you prefer not to use the equal high and low indicator. So since the fractal moves are not as big as the swing and internal structure, we don't map them, but we use these fractal moves to get a sense of when the price may start to shift. In our strategy, this shift of direction is called the chalk, and you'll see this type of break happening a lot as we start to map the charts. In the next lesson, we'll learn about chalks. A chalk is a change of direction, and we use this type of structure break as an early indication of a change rather than a confirmation of direction. As we saw in the fractal section, as price continues to move and create fractal structures, when the price completes its move, it may start to change direction. The chalk will be the first signal that alerts us of this change. A chalk occurs when the nearest low in a bullish trend or a high in a bearish trend is broken. Think of it as a change in wind speed. Change in wind speed can be a signal that it might start to rain, but it doesn't necessarily mean it will. While a chalk is a good indicator, we need more confirmation to add it to our bias. Keep in mind that chalks will appear in the right and wrong places on the charts. We will only be looking for chalks at high probabilities point of interest, which we'll learn how to spot in upcoming lessons. Hello guys, so I just want to do a quick video here so we can go over the concept of the chalks, because this will be very important because we'll be using in all of our time frames, including the analysis, the 15-minute, 4-hour daily, and the 1 minute for the entries. So I just want to go over this with you guys, like a little practice. Just the first thing, let's remember that for the fractal breaks, we don't need a candle body close. We just need a wick. So every time, like here, right? So every time the next candle doesn't break below this, which means if like every time a candle does not break with at least 1 micropip below the next candle, that's considered a fractal structure. All right, so I'll just be playing here with the bar replay so we can be looking at how it works. So as you see here, like starting on the first one, the first candle, the next one already broke above. The second candle already broke above. Third candle, the same, you see. So there's no fractal structure here yet. So the same. And you see that sometimes this candle can be like a, let's say this is on a bullish move, but sometimes the candle you see here, like it has, like, even though this is a bearish candle, this one is still broke above this one. So like this could just like continue up and continue the move, and this wouldn't be a fractal structure. Now it is, because this one didn't break above this one. So right now, let me just pause here for a second. So as you can see, like after this one, this next candle, it didn't break above this. So this is a fractal structure already. So now we gotta see what is the nearest candle, like the nearest low candle that didn't break the next candle, you know. So like as you can see, like after this, all of these ones, they broke above. So it's the same concept as the push, pull back, and push. So this would be our most recent lows for the chalk. Let's see how it plays out as we continue. Yeah, you see like even this one, it broke above there. So this is still continuation. So this would be like the continuation of the higher highs on the fractal, you see. So once this lows here are broken, like you just saw there, now we have a bearish chalk. So this would be, let's see here, I'm getting out of space, but I'll just put a chalk here. Chalk, oops. Yeah, so this is now our chalk, like I said, because this one didn't break above this, so it did a pullback here and broke above. Now the most recent low, it's this. So now we have a bearish chalk. And I remember that chalk is just a signal that price might just start pulling back, but it doesn't need to. It could just do a higher high here and then continue up. But this is a good indication, so we can wait for like the pullback, and then price can start to do like a bigger pullback to maybe these areas to then continue up. Okay, so continuing here, same thing. You can see that this one broke. So as you can see, this candle broke below this. So this would be our first, the candle that didn't break. And so now we had this candle broke below this, and it pulled back and it broke above that one. So this would be a fractal break to the upside, because this was a pullback, then it broke below, and then it broke the most recent high on this bearish move. So right now we would have this as our low and this as our high. But as you can see, this, you're going to learn later that this was just a sweep of liquidity to continue the move. Like, that's why I was saying that the chalk will happen in the wrong and the right place. And so we're just going to be like looking at these chalks on a very high probability point of interest that price may start to change, because a chalk can, a break of fractal structure can happen like in the middle of a move, but we are not looking at that. We just want to use the chalk as the change of direction. So it's just gonna be happening. I mean, we're just gonna be looking at these types of movements, the chalk, at these high probability places. So as we continue, the same. So price just continues down, and let me see if I can speed it up a little more. Yeah, you see, so price continue to break below. I put on the 10x. All right, so as we continue to move down, so you see like this one broke, but this one didn't break, so this would be a pullback. And now this one is a little interesting because we had like this huge doji candle, which is like an indecision candle. But the same, like, you gotta think as the candle formation as like a push and pullback. So this, you can see that this was a pullback, and then there was a break, and then we had a break to the upside here. And like I said, it all depends on the volatility of the market. And you see like these huge or crazy candles, but you need to be able to read the market and the structure as it is. And as you can see, when price broke all the way down here to mitigate something, a demand, which we're gonna learn later, then we had the chalk on the top here. I'll just grab that one. So we just had this chalk here, and then price did the same thing. So now we had this break, and we can continue to look for the move to continue. So as you can see, the same thing happened after the change of direction. So you can see that these two candles here did not break this low. So this was like, this is a very good example, because this is more like experienced. If you're experienced with this type of structure, you can see that price break, moved here down, pushed, pull back, push, and then we had this break, and then that was a pullback to continue up. So you can see right after the chalk, this price did not break below this, and so this was on a lower time frame. That you see that this was just a pullback to continue the move up. So let's see what happens next. Let's just look for another example. So just to nail this down, and same here again. We had this one didn't break, so now we have this one as our lowest point after this break, push, pull back, and push, and this is our lowest point. So if price breaks this low, then we're gonna have a chalk. As you can see here, price try to break this high, because the job of this one would be to break this high, and you can see that price pulled back, pushed again, couldn't break this high, and then now it's moving. It seems like it's moving down. And what happens next? Let's see. And just let's see. Yeah, like right now we had another bearish chalk. Another great example here, because as you can see, like we only see like after this pullback and this push. So this is just a push. So this price here, I mean this movement here, it could have stayed inside this like pulling back for and kind of sideways for a long time, and still let me delete this, and still this would be the low and that will be the high. So anything that happens inside here, it doesn't matter, because we only gonna get a chalk when the fractal breaks this low here. So now we have our bearish chalk, which is like I said, just a signal that price may start to like make a bigger swing pullback to then continue up. So I think you guys got the point and how it works. You will see different types of structure when you start trading. You'll see that price can come here and then start making higher internal lower lows, and then internal higher highs. And when if price would like fail to break this high, then we would like the nearest low would be this, and you would see like that price signal with the chalk here, the change, it would probably pull back to then continue the move down again and maybe take out this low. So this is a little more complex, but you guys get the point. And like this would be our chalk. You see, and the same here, low, high, low, high, and then this one didn't break this low, and then we had a chalk up here. This would be like an internal structure, but you got the point. All right, guys, so let me know later if you guys have any question, but I think this should explain this type of structure that we mentioned before. Now that we learned the theory of the structures and everything, so let's do some practice on how to map the swing structure, the internal, and the fractal. So I draw this little example here just to give you guys an idea. So later on we can go to the charts and it will be easier to understand that way. So if you remember, the most important type of structure is the swing structure, and you will see them because they're the largest moves that you see on the chart. So like it's every time like that you see like the largest moves, that will be the swing structure, right? So those are the most important and easiest to spot. And I would say if you only know how to spot the swing structure, you'll be fine because sometimes all the little movements and everything, the craziness inside of the charts, it kind of like makes you like, oh wow, I'm not gonna be able to do this. But the main movement that you need to be watching is the swing structure, and the other ones are just more of a confluence that goes on top of the overall analysis for movement and direction. So let's start here with the first push that we had. So this was a big push, so we can mark this top here as our swing top, swing high, and then we had a pullback. So when we broke this first structure here with the candle body close, here you're not going to be able to see it because it's just lines. So just a reminder for you guys. So when we see a break here with the candle body close, so then we have our confirmation that this is our swing structure, right? So next we see the internal structure, which is a small structure, because you're not gonna be you cannot define, like, look at these big movements, right? So like you cannot define this as the same as this big movement. So that's why they're just like small movements that create the big movement, right? So these are all the internal structure. It just helps us to see where price is going and like how it is creating the large movements that we see on the charts. So again, so after you see like maybe a push or even inside of a structure, but in this example here we have a boss, right? A swing boss. Then we have this small movement here. So this is an internal structure. And again, we use the candle body close to confirm our break of internal structure. So here, when you see a candle body close, like by a micro pip on top of this, then we have the confirmation. And you can see here, like I use the orange dots for the internal, and
So here we have another confirmation that price wants to continue going up, and this is the fractal structure, which is gonna be just like sometimes one or two candles, sometimes it's just gonna be like a small pause and like two candles. Like you're gonna see like two candles with the same, with equal highs. Those are also considered to be like the fractal. So like we don't map this because these are just small pauses in the market, but you see here like when it came back, it respected the demand that we're gonna be learning later. So it respected the demand of this fractal, and then we had another push. So just keep this in mind. And as the price was continue to go up, then we saw a bigger pullback, which we can now like, okay, so this is a like a larger pullback. It's not like this, and it's not small like this. It's a larger pullback. I'll teach you guys in the next video how to make this a little more mechanic by using pips to measure these movements, and you'll see that every time that we have a push, and you see that we have a bigger pullback, then you can already set this as the top of the swing, because like when we have a bigger push, so like when you start to see a bigger pullback here, you can already mark this as your swing high, and that will be the swing low. So, and again, right? So when we have another candle body close on top of this line, this is the most recent high, then we'll have another swing boss. So now we're gonna have, this is our swing low, and we can only set the high here as our swing high when we start seeing a bigger pullback, so we can see, okay, this is a big movement. So if it's already pulling back, then like we can set this as our swing high. I hope you guys are understanding this. It might seem a little more complicated than it is. This will be one of the easiest parts for you guys. But yeah, just think about the movements, right? I always like this helped me a lot, because I always think about like the movements, right? The high highs in every time frame, 1 minute, 5 minute. I'm always looking, because if price is doing this, right? Let's say like it's just like moving like whatever. You see a lot of like 1 minute movement. It's still like a push and a pullback and a push, So like this doesn't matter. Like what you need to be looking at, it's how price is moving overall on a bigger picture. So these small movements is just to catch the price. Like if you want to catch the price pulling back and then you want to take shorts. So that's what the other fractal internal are for. So continuing here, after we had this the swing boss, then we had another fractal, and so we had a little pullback on the fractal and then another push. So this is it's not a internal and not a swing yet. And then we had a chalk, a bearish chalk, our first bearish chalk here, because it's reacting to a swing supply, which we also learn later about supply and demand zones. So like it's reacting to a very important area. So this is our first sign that price might start to switch direction. And like I said, it doesn't need to. Sometimes the chalk can just be like it's just to facilitate price to come back to a place here. It will come like it will come to a place like here, and then it will push again. But in this case, we had a bear shock, which is the nearest low in this movement. So like once this breaks the nearest low, this is already a chalk. And then usually it doesn't have to go back there, but usually this would be an entry here for shorts. You're gonna see later on our strategy, and this could be like some entry, so you can start taking shorts before it reaches a zone inside of here. But this is for later. But so okay, so after we had the bearish chalk, and now here we had a bearish boss. So like after price broke with the candle body close below this, below this line, now we had a bearish swing boss. Okay, so we're not gonna be, after this break here, we're not gonna be marking with our swing low until we start seeing some like nice like pullback, right? Remember the push, like if we just see a little like pull back like this is not our swing low yet. But if if it continues to go up, then okay, we can see this as our low. But if you just do this and then continue like this, just going down, okay, is this our pullback yet? Like if we see this whole movement, this is gonna be just one movement, and then price will maybe do a bullish chalk, pull back to continue down. So okay, so we saw this small structure. So then now we have our bearish our bearish IBOS, because it's the internal structure, because this is a small structure. Then we had a fractal, and then here when it broke the the fractal structure, the nearest high, now we had a bullish chalk, and the price came to mitigate something here. So let's talk a little bit about this internal here. Like I said, guys, like the internal, the chalk and stuff like that, like in the beginning, it's very good for you guys to be marking this, because this will like make the chart more clean for you. But it's not very important like that. Like if you can see how price is moving, just like with just with your own eyes, it will help a lot. But it's always good to mark in the beginning. But anyway, so we have the low of the internal, the high of the internal, and here, like you saw that I marked with a swing low here, because we already saw a bigger pullback. But if you could see, if we're gonna mark another the internal, this would be like low, high, low, and now the internal, it turned bullish, right? So you could make your dot here, one dot here, and this would be your internal low, and that will be your internal high now, because this turned bullish. You know what I mean? But like if you look at this, I mean, you could put a swing and an internal here just to make it more clean for you. But you can see that this was the low, high, boom. Now it turned bullish. But like, why did it turn bullish? The price just turned bullish for the bigger pullback to come to mitigate something here, right? Like we don't know, because we would have to do some analysis with the candles, which we will learn later. But price only had this bullish chalk, and the bullish internal turned the chalk was a bullish chalk, and we turned internally bullish just to mitigate and facilitate this movement, right? Which is the most important, the swing structure. So after that, you can see that price pushed very fast and pushed very fast down. So you can see that if there was a lot of orders here on the supply, then these orders was all filled, which made the price go up, down very fast. And now here we had just a small reaction, and then we continue down. And you can see price like swing high now, swing low, and like I was mentioning to you guys, just the internal, it turned bullish to help us with the pullback on the swing. And this will continue over and over again. You might see another small. It depends. This is all like depending on like um, how bearish, let's say here, right? How bearish it is. Sometimes if the price is very strong, it's just gonna give you some internal, and then you're gonna see another like a bigger pullback, and then you're gonna see and then you start marking like that, So, all right, guys. So let's jump into the real charts. But I think this was a very good scene, so you guys can see that the price, I mean the market, the charts are complex. It's not very clean like this, But like if we understand this, like 100%, you'll be able to do your structures on the real charts. And once you start seeing like this kind of stuff on the real charts, you get a lot more clarity, like why price is doing what it's doing and where it's going next. And yeah, like that's gonna be life changing, as it was for me, because before with other strategies or stuff that I used to do, I was kind of like lost, because like where's price going? Like, so this is just a break and retest, but like where is it going now? And then and sometimes it would like do like a flag and come here and go back down. It's like, okay, but it's supposed to go down. I mean, it's supposed to go up because this is a bullish flag, but it doesn't work like that, right? You gotta see like if we had like a push, like where is it reaching? Where is it going? Where did it stop? What made this move here stop right here and made the move continue down, right? And like I said, like some people might see that, oh, this is still bullish, right? Because this maybe creating a flag here, like 1, 2, 3 flag, boom, going up. So this have to go up. No, it doesn't have to do anything. The price and the charts will do whatever it wants, and this, right? So as we saw that the swing was bullish, and okay, first signal that price may start to go down, but as long as this one was protected, the bullish could still come here and go up, because this is a protected swing low. But once this was broken below, okay, so now like if now you can see that price is switching the direction. And just before I forget, this type of mapping, like as we use on the boss, iBoss, everything, you're gonna see in all time frames: weekly, monthly, daily, 4 hour, 15 minutes. So like this will work for all of the charts are, they all look like very similar in all time frames, and you can use this type of mapping on all time frames. So this make it easier. So you only need to learn once. Okay, guys, so let's jump to the real charts and let's use the same analysis, the same type of structure mapping that we use here on the real chart. So let's go.
Okay, so now that we went through the introduction on how to map the structures with the lines, so let's do a real practice here on the charts. So first thing, I'm gonna make sure that my sidebar alerts our own, and you can see that it lights up like on the inside bars. That means that the bar it closed inside the recent bar. So as you can see here, okay, yeah, this indicator is very good, and I leave it on all the time. Okay, so the first thing, like I said before, like first thing is like look at the how the market's moving, you see, and then you see you can already, like, without anything, you can already see like how the swings are moving, the swing structure are being created in the market. So right here we have a bullish swing structure after the after price closed above this recent high. So this was um, now this is the low, and now after price break this high here, now this is the low, and we only know where the high will be when we have a decent pullback. So we will be able to mark the high, but we don't know that yet because it's still just like doing some small movements here. So let's continue. Now we have an internal structure because it did a small structure here. This is more visual, like this is not enough, to map. And you can use your discretion for internals. Like when you see that it's not like a big movement, but like it's still like some movement, then you can mark it as a internal. Okay, so let's keep playing this. Okay, so as of right now, there's nothing. Okay, so now we have a fractal here. As you can see, this candle didn't close above the recent candle. So this would be our most recent low, because like if you can see price on the lower time frame, it would be easier to see, but price came here, pulled back, and pushed up. So this is a fractal structure, and now we have this low as our most recent low. So if we get just a wick break below this one, this is gonna be already a chalk. So let's keep playing. Okay, right now we have a chalk here because, as you can see, like you can see on the low here, that is I'm showing exactly how I map this the charts when I get to the computer. So you can see like the lows here, right? Like look at the numbers. That is 8658, and this one is 8650. So this already broke, because sometimes like this one, the low is 8658, and this one will be like 8657, which is like it's barely visible. And that's why I said that you guys can use this this data here to make so you can see, so you can like be sure that it broke below this. So we have that. Let's see, and then we can mark with the chalk there. Oops, wrong one. So this is a 4-hour chalk dark. Okay. All right. So we keep going. I'm not gonna be marking the supply and demand because we are not there yet. But like, let's just keep marking the our structure, so we can focus on that for now. Okay, so as you can see, we got the first signal that price may change, because it stopped at a very high probability strong resistance supply. We had a chalk, then it had a pullback to retest these areas here. So it could probably mean that this can be the first signal that we might start getting the bigger pullback. Okay, and it's still the if we're counting the internal structure, we still have the internal structure here and the high, and so this will be the low, and now this will be the high of the internal as well. So just keep in mind that if we get like this already are looking like we're gonna get a bigger pullback, but we need to wait a little more. Okay. Yeah, so right now, so I already would have this as my swing high, right? And let me see, let's keep playing. And yeah, you see, now we would get our internal break to the downside. So sorry for all the, because I used to use a white chart. That's why I have this so many names there. So you see, high of the internal, low, break. Now, okay, once this is broken to the downside, now this will be the high of the internal, and like when we have a decent pullback, this will be someone here will be the somewhere here will be the low of the internal. So just stay with me, guys. This is some good practice. Like you can see, we have their swing already, and so like if I would explain this on the analysis, I would say that the bullish, I mean the swing of the 4 hour is bullish, and the internal now turned bearish. So you see, like when we got the break here, now we had the internal turn bearish. So as we continue, you see we would have another internal here. You see how it plays out, because like we would have the internal there, the eyeballs, and this would be the low now. Low, high, after we got a break and a close here, now this is our new high, because after the pullback, boom, this was the most recent high. Okay, now we got a break again, so let's continue. And just remember that this is still our low of the swing, and that's still the high. So this could be just doing like a push and a pullback, and then probably the internal could turn bullish here, come to retest somewhere here, and then we can continue up. But we will only know that after like we get a confirmation. So again, we have another internal here. Our swing low is still protected here. Let me just copy these guys to make it more clean. Oops. Yeah, of course, this is not gonna work, right? Let me go back here. Okay, so the same thing, low. We had a decent small structure, then we had this pullback. This is the most recent high, broke again with the body close. This is our high. Okay, so right now, there you see, price is still breaking down the same. We have our internal. And so what happened now? So here now, so we had like a swing high, swing low, swing high, swing low, swing high, swing turn bullish. Maybe it just came to retest somewhere here. And like this could be just a pullback. But as you can see, now it broke below the low. So this was a protected low, but now we got a break and a close below. So now our swing is bearish again. So let's mark this for our boss. And this is just one time frame. And like I said before, like on the daily, on the 4 hour, 15, you're gonna use the same type of mapping. And as you start to put them all together, you see that like you start to see the story, like where price is going, why it went all the way up here. Maybe this is like a daily pullback, and it only turned bullish here to come to retest something to mitigate a supply, and then price would continue going down. So you see, like the price, it keeps going and like creating structures and on structures, and you can see that it looks way more clean or more clear for us when we start mapping and seeing like what price is doing, you know. Okay, so now that we have our bearish swing, you see with the body close, the same thing. So what do we need here now? We need to see a decent pullback, because now this is our strong high, and we need to see a decent pullback to know that this is our swing low. So let's keep playing this. This was just a fractal. I don't know why this is here. Okay, so we had a bullish chalk. Let me see here closer. Yeah, this is a very good example. So this was a fractal, right? Fractal bearish structure. But you can see that this last one here, like these three candles didn't break below this. So this is still our high, and this is still our low. And only here that price broke above that one. Now we have a bullish chalk. But as I told you guys before, it needs to be in a place like price needs to be how can I say, reacting to a very strong demand here, because price could just be making like a small pause, come here, take out liquidity on top of this and continue, and then come here, you know. But this is, I mean, it's still a chalk, but we're not waiting for a reversal. It's like you think about a train, right? Like the train is going. It's not gonna stop and turn in the middle of nowhere. You need to wait for the train to come from this station to a station where it's supposed to stop, to then turn, you know. And in the next lessons, we'll learn about the liquidity and what this is, like what is it doing. I'm not really sure if it's reacting to something here, but yeah, we'll be looking at this later. But right now, let's just put this as a chalk, since we had a break. So this is a bullish chalk, right? 4 hours bullish chalk, okay? Because structure, pullback, push. This is our most recent low, recent high, break with just a wick. This is the first break. We don't need the candle body close. Okay, so continuing, let's see what happens. You see, Then it just come here to protest maybe this sell to buy, which we will also learn later, and then to continue down. And even though like we had the chalk here, but still this can be our internal structure as well. Look at that, because this was a decent structure that we can map. So let me just grab these guys, boom, and let me see if, of course, that would happen, right? Okay, still the high. You see like how more clean this is and how it's not that hard once you start doing this over and over again every day. This is like, as a trader, like the mapping is something that you're gonna do every single day. Like you're gonna go to your charts and see, okay, my swing is still there. Was there a break here? And you can set alerts, right? I'm not gonna be able to do that here because of I'm doing bar replay, but you can set alerts on the trend lines. Like once the candle close, like it's gonna alert you that we had a bearish swing. So you don't need to be here all the time. And for each candle here, you're gonna have the time that let's say like we have another 3 hours for this candle to close, for the 4 hour to turn bearish. You have a lot of time. So one of the things about trading is that it's a lot of waiting and patience, and that's why the mindset is the most important thing, because you don't need to stay here and like, oh my God, I'm gonna miss a trade. Once you have a strategy and a rule, like for you to enter trades, you're not gonna be FOMO. You're not gonna be like thinking, am I missing a trade? Should I be watching this all day? No, So like you're gonna have your alerts in place. Once they hit your alerts, then you're gonna like you come to your computer, or maybe you can be studying and doing other stuff. But that's how it goes. So let's continue with the mapping strategy here. Okay, so do we have? Yeah, you see, very good example too. So this, like once the body of the candle close below, it can be a small close, it doesn't matter. Like once it close here, this is already a break. So we can map this one here as our internal, this one here as our high, and this was a break. And now this would be the low, the high, and what happened there now? Now we turned the internal turned bullish. You see? And like I said, I'm gonna be saying like I said a lot. Like look at the movements. You see, you can spot these small movements. Like the swings will be like this, and then you can see the small movements are like small and pauses, and now we have turned bullish here. So where is our low? Now our internal low is here. So if we get enough pullback, then that will be our swing high, and somewhere here will be our swing low. Maybe this one, because it seems like there's another tip too. Usually when we have like a switch of direction on the internal, that most of the time that already means that we're gonna have like you can already mark this as your swing low in this example here, because we're bearish, right? So like when we have this like low, lower low, lower high, lower low, lower high, lower low, now we turn bullish. So this could probably mean already that we're gonna start like a deeper pullback somewhere here. It doesn't need to go all the way there. It depends on how bearish the move is. It can just come here and then go. But this is still will be our low, swing low.
and that will be our swing high. So let's keep playing. I hope you guys are getting because this concept, because we're gonna be using literally every single day, like when you're doing your analysis. So now we had another. You see, you can mark this, and probably when you get it about the swings, the internals, you're not gonna be marking so much, because then you can mark just like the most recent ones. But this is gonna be a little more messy because we are trying to do like everything now. You see, like high, low, and yeah, we can already see that this will be our swing low, because look how deep the pullback is already. What did I do? Let me mark this guy here for dark. Okay, you see, swing high, swing low. Our swing, which is our most important one, is bearish. So even though price may still come here, like, you always think that the swing structure is more important than the internal and the fractal. So this could be just to come somewhere here and will turn bearish, then for us to continue the move down. So let's keep playing. Okay, again. So now we have this swing high, because this was already a decent pullback, and that it's still our protected low, because the internal is still making higher highs. So if we do have a break and close below this protected low, then our internal will turn bearish. But let's see. Okay, we now have another pushed up. So now we have, I keep doing this thing. So now we had this, you see, boom, high, most recent low, break. Now we have this as a high. And what happened here? Again, it doesn't matter if this is like, even though it can be, this is very narrow and small, it was a decent move for us to set it as a internal structure. Okay, so what happened now? So now we turned our internal bearish, and I'm gonna just put this line here for you guys to see that oops. Let's see. Okay. So like sometimes you just need to zoom out and see what's going on, Okay, you see? Boom. It can be doing this, or price can just come here, try to break this, and then it can fail and continue up and break this. And just always think that the market can do anything. Like, you can have your bias because this is bearish, but always think that it can just stop here, it can break, it can turn, it can do whatever you want. We just react to price action. We're not gonna predict what's gonna happen. So that's one of the things. One of my goals with this course for you is to have the professional trader mentality. Like, nobody will be able to fool you anymore. Oh, I can predict the market. Oh, I know this is going here. No, you don't know. Like, nobody knows. There's so much going on in the market. There's so much going on in price, inside news and political, like, whatever, that makes price move that nobody knows. It's so many things that can impact price and where it's going. So you can, like, if someone just make a lucky shot and say, oh, price is gonna go here. Okay, yeah, that I can do that many times too. But it doesn't mean that I know where price is going. Okay, sorry about that. So continuing here. So once we have a candle body close below this low, then what? Then we're gonna have our swing bearish boss. So let's continue playing. Okay, boom. All right, so what happened here? We had a bearish internal and a bearish swing. Why did I just delete that one? I don't know. Okay. And boom. You see, we had a break, the push, pullback. This is the highest number where price came after the pullback. We had a close candle body close below this line and this line. So we now have an internal bearish move and a swing bearish move because both close below this. All right, so let's continue here. I like to, if you I don't know about other computers, but if you use Apple and you grab this line and hold shift, you see that every time I hold shift, it straightens the line. This was very important to me because in the beginning I didn't know this, so I would try to make this line, go straight. But if you just hold shift, it's gonna go straight and it's gonna stay in the straight line, as you can see here. So do that. And also another tool, since we were talking about this, I use the magnet here. Like you can set this magnet, so every time the magnet will magnetize. I don't know how to say it, to the most recent low. You see, it try to fit the most recent low of the candle. So I would suggest you to leave this on. So like every time you try to get the most recent low here, the line will already kind of glued to it. Okay, so we are almost done here. I think you guys get the sense on how to do this. So let's just play a little more. Okay, yeah, you see, price, it came, I don't know, did it hit here? Yeah, you see, like we'll see on the next the next lessons, that price doesn't come here like just because. There's a reason why price came to this number here, and you see why our strategy is so powerful. And like it actually blew my mind when I started studying price action and studying smart money concept, because like it makes total sense. All right. Yeah, so now we have everything bearish. Since we're already here, right? You see that like we had the bearish internal and bearish swing. Price pulled back to this like very high probability POI here on the 4-hour. Like this is like when you using price action and structure, now both are aligned. Both the internal and the swing is aligned with price action, so you can like be sure that, like, not sure, but like you have a higher probability that this move will hold price, and you can be taking shorts from this POI. Let me continue. See, kind of fractal.
I'm not gonna like this is too small to be internal. I'm just gonna wait for another pullback so we can mark. Oh, I just forgot. You see, when we had this break here, this was our most recent low, and after this pullback, this is our most recent high of our bearish. So you can either leave this as the orange so you can be checking both, but I change this to the swing dot. So now you see high, low, high. So the swing in turn is bearish. And like I was saying, this is too small to be internal for me. This would be like a fractal. Continuing, you could set this. And another thing, guys, like if you get it, you can get it wrong sometimes, and you see that it doesn't matter too much. You don't need to be like, oh my god, I did it. No, like I said, the most important thing is to be looking at what's going on here. The most important thing is to be looking at the waves, you know. So if you even if you set this as an internal, and then price switches up, and then it's gonna come here, and then it switches bearish again. Like, it doesn't really matter if you messed it up, because you are following order flow, you know. So okay, now we have that as our high. Boom. You see, like swing, right? Swing structure. There's no enough pullback here yet. Let's zoom this out. You see, like, look at the difference about like this, and this is just a push. There's no enough of a pullback yet for you to set this as our swing low. So let's wait a little more. Let's see if we're gonna have a pullback. And another thing, because like sometimes we say, oh, like price is already extended. That means that because we had a bearish swing boss here, and we already had like this big push. Oh god. Because we already had this big push, so we may see that price is already extended. That means, like, if it just came here, it doesn't need to like pull back here already. But like when price is already super extended like this, it doesn't mean that it needs to start pulling back. It can just continue down. But it's most likely that after a big push like this, somewhere down here, you're gonna like be looking for the reversal of that move. So let's continue playing. So yeah, here, right? If we want to look at the fractal, let's say that price stopped here at a very probable place for a reversal. So here, so we had the like this, we had this pullback, right? And then we had a break below, and this was the most recent low. And let's see, that was, yeah, this, it will probably be like this one. Sometimes the chalk is also kind of confusing, because we can have like this internal, which is the pullback. Let me grab this guy here. So we had this pullback here, and then this push, and now our most recent high like will be kind of like this one here, because this is our inside bar. And sometimes you can go to our lower time frame, and you see it more clear, like which one is the nearest point in the move. And then we can set this as our
bullish chalk. Yeah. And like I said, again, if you get it wrong, sometimes I would like, oh, because I want to make it more clear instead of just like having the lines going through all these candles. Like you can just like mark here if you need to go to a 1 hour, 2 hour to make it more clear. You can just do that. But so now we had the bullish chalk, and this is still our internal low. Let's see what's gonna happen. Did we get a break above that? Yeah, you see it? Not yet. This is still our strong high on the internal. So let's see. Yeah, like this is not a very big pullback, but you can see that there's a lot of price action inside this. Another very good example, so you can learn how to set your swings. So like once I see that there's so much price action, so much movement inside, it can be ranging as well. But like even though like we didn't get a very deep pullback, but once I see like a pullback like this and like price is kind of ranging inside, I already set this as a swing because I see a lot of action here. So right now mine low would be here for the swing. So now we had this swing high protected, swing low, weak, low, and that's still our internal the internal high, because that was like a push, low, high, boom, break. Now that's still our strong internal high. So let's see what's gonna happen. Just this last example, and let's see what's gonna happen. Yeah, it's great for you guys to see this, right? Because price is stuck in between these two zones here. You see, like there's nothing much. Like later on, as we start studying, as we start like doing our analysis, I'm gonna be telling you guys like stay out of the middle and like just take and look for the places on the edges of the movement, because like right here you see like that price is just doing whatever it wants, and like you don't want to be messing with this. And if you need more confirmation, what would what would be the, like let's say you need more confirmation here, what would the confirmation be? So it will be like price turning bullish and coming back to continue, or then price failed to break this high and continue down. Right now we don't have nothing because price came here and it continued just like moving inside this. This can be anything. That can be like a slow week, or this can be like around news in a lower time frame, like on the 15th. If you see this can be just like whatever, like the market is waiting, like indecisive. This is indecisive price action. I don't know if that's a word, but this is just like price waiting for something to happen, right? It's accumulating orders here to then take a bigger action. All right, so now we had this internal turn bullish here. Oh no, we don't know that yet. So let's see how. But right now we know that it turned bullish. This would be their internal low, and let's see, and price could just have gone there to kind of sweep. Yeah, I see. Again, I think you guys get because this is going for that's going for a long time already. But I think you guys get the idea of how like this mapping works. And you can see, where is it? Just use another one here. So after boom, low, high, after this break, the pullback went here. What is the lowest number? This one. You see, after the push and the pullback, what is the lowest number on the pullback? Here. Boom. Okay, and then it's gonna continue. So price may come here, boom, and then it can fail, then it can break the low, come back to retest, and continue the movement down. Like I said, guys, don't think that you're gonna get this right away overnight, because you, oh no, now I understand and now I know how to do this. No, this is hard. This is not like, trading is not easy. So it's gonna take you some practice, and later on the, when we've kind of finished our course, I'll go over a video for you guys about practicing placing, creating your analysis, like being very disciplined on like posting your charts, so you can get feedback, and like as more as you practice this, I tell you, like the more you practice, you kind of, you're gonna avoid so many losses, because you already know what price is doing, and you're not gonna be getting in the middle of like nowhere just because you have FOMO and you don't know what to do. Like, I'll give you 100% like what you need to do to enter trades, to do your mapping, to wait for the right area, to not take low probability trades. That's what nobody is showing you guys, and I believe that's the only way for you to become successful. That was the only way that made me changing how I was trading before, and that was the breakthrough on my trading. So, all right, guys. So this was a very good practice on mapping. I think for now on, you guys can look at this video once or twice and go over as many times as you want. But I think you guys already have the idea. You can still steal my my colors, and we can go and be practicing more. So hope you guys like this video. Let me know if you guys have any questions. You can contact me anytime. I'll be able to be answering your questions, and I'll see you next. All right, guys. So before we move on to the next lesson, I just wanted to show you guys two tools that we can use for mapping, and for you to kind of like have even like a more confluence on your mapping and price action in general. So one of them is to make your swing structure more mechanical, which that will help you like to, if you struggle seeing like where you should mark your swings, then you can use this technique. So like, how do you do that? Like, first thing, you can go to, there's this tool here, which it measures like the time and how many pips it pulls back on the charts. Or you can also hold shift and press, let's say here, right? We had this, like I said, like you can see it with just like without any, just by looking at the charts, you can see the movement. You see that? Boom, boom. Okay. So this would be our like swing low, swing high. Then this was just like kind of sideways going down. Then this was their swing low, swing high, swing low, swing high. Okay. So you come here, and this would be our swing low, right? You come here, and then, oops, gotta make sure that it's glued to the lowest point. So you come here, and you click, and it's going to measure like how many pips it pulled back. So you can see that that one is 128. It was like 7 days, 30 bars. You can see all that. So this was the 128, and then this one was 152, and this one was, you can like measure the last 5, last 6 just by looking, remember, like the push and the pullback. So whatever the lowest number is, you see like this is 95. So you can make a rule: if price pulls back, if it pulls back, if it pulls back, if price pulls back like less than 95 pips, then you're not gonna set it as a swing pullback. Let me zoom in here. So like, let's say price only pulled back like 60 pips. So then you're gonna see that this is not a swing low yet, you know? So then you could, like, you would have your swing high here, and price could just come here 60 pips and continue down, and then do a bigger pullback. And this would be your swing low, and that will be the swing high. And you could even like see here, if you didn't want to set this as your high and this is as your low, this would be just a pullback. And you see it didn't break above that, and it would continue down. You see that it works the same way. The mapping is just to help you. So yeah, so measure the last 5, 6 swings, the swing structure. See which one is the lowest number, and you set that as a rule. So if it pulls back less than 98 pips, I'm not gonna set this as the swing. Okay, that's one way for you to make your swing more mechanical. And another tool we use, it's the discount and premium price. So we can use, to tell you the truth, this is just a confluence I use, but I don't use this tool a lot, but it's good to know in the beginning. Like I said, like a lot of that, it comes with experience, but I'll teach you what it is. So basically what it means about the discount and premium prices is that on this move, like let's say we had this this swing move, right? So we had this swing move. So you don't want to be selling on these lows here, right? Like if we're doing like this is a swing, so this is different. This is the 4 hour, so it's different because we usually look for entries on the 15-minute. But let's say like you don't want to, after price pushes, like what does price do after we push? We usually have a pullback, right? So you don't want to be looking for like swinging, like entering a short here, and I want to target here, because you already know we had a bearish boss, and price will probably pull back somewhere here. So what we use is the Fibonacci tool. Yeah, you can. It's called the Fibonacci retracement. So you're gonna use that tool and like click on top of your swing to the low of your swing. Let me just remove these extensions here. So you're gonna set yours at 0, 1, and 0.5. So all that means is that this is the EQ, the equilibrium, the 50% of this move. So this would be 50%, and that would be 50%, and this would be the middle of that move. But you can see that price doesn't need to go there. That's why I don't use this tool a lot. I just wanted to let you know that you can be using this confluence, because sometimes, let's say there's a, like later on we're gonna be learning this, but let's say your most recent supply is all the way up here, but price already got to the equilibrium, so it doesn't need to go there either, but it already reached your 50%, your equilibrium, and it can just go from here, you know. So you might be like, okay, I'm not gonna be taking longs because it already reached my equilibrium area. So this is a good tool that you can keep, and that works for any time frame. You can use for any of the like internals as well, but it's better used on the swings, so you can see every time. Let me see here. Yeah, so you can maybe like use it here. You see that now, after we had this push, we could expect price to come to like the 50% equilibrium, and you see like the charts and the price, it's very, you can see that the charts and the price, it moves like pretty organized. You know, now it reached this 50%, which aligns with this supply here. See, and let's see what happens next. Let's see. Yeah, you see, look, price came to the 50% area, the equilibrium of this move, and after this, remember what I just said, price just died from there, because it already reached the area of a premium area where you can be selling. It's the same, like trading is like buying and selling, so you don't want to be buying too high, you know. So if price is already here, you don't want to be buying high. You want to wait for price comes to the discount area to then you buy it again. Okay, so let me know if this is useful, and you can be setting this. As you map, you start using this tool to map the areas where of the swings, and see how price reacts to that. And yeah, I think this is a very good tool. And so yeah.
Multi-Timeframe analysis. It's the process of analyzing an instrument by looking at different time frames. Every trading chart will give you a different perspective to help you analyze the historical data of the pair you're trading. So when doing multi-timeframe analysis, more is not actually better. Looking at too many time frames can get you confused, and it can also be unnecessary. It is better to have a strategy and follow that for your analysis. Otherwise, you ended up trying to force a trade because you're not allowing the chart to show you the right information. So in our strategy, we trade using the daily, 4-hour, 15-minute for overall analysis and direction, and we look at the 1-minute time frame for entries. And at the beginning of the week, we might also look at the weekly chart just to help us paint a bigger picture about the week. I would also say that learning multi-time frame analysis is one of the most important parts of trading. We all get confused when we're just trying to understand this part, because it can look like a messy puzzle until you start putting all the pieces together. But don't worry, with practice, everything will start to get more clear. Think about multi-time frame analysis this way. You are in an airplane flying over a stadium. If you have a very good camera and zoom out, you only see the stadium from the outside. But as you start to zoom in more and more, you will be able to see the field, then the players, and even the ball. That's how multi-time frame analysis work. It will help you to see the big, medium, and small picture, meaning you also see how investors are seeing, the swing traders, and scalp traders. And when we do multi-time frame analysis, we always start from the bigger time frame to a small time frame. This was one of the things that I learned first when I started learning about multi-time frame analysis. A run on a higher time frame is a trend on a lower time frame. And that's true for all the time frames. Guys, you gotta remember, we are doing the weatherman's job to create a forecast about a market direction. Price action doesn't follow our analysis, we follow price action. A professional trader does not predict a movement. He will react to what the market is showing. So here we are again. Like always, I believe it's very important for us to look at lines and how are we seeing the structure of the market before jumping into looking at candles and how the market is moving in real time. So let's just go a little about the basics again of the swing structure. So to understand multi-time frame analysis, let's start at the beginning, like let's make it simple, and we're gonna look at two times frame. One is a higher time frame and one's a lower time frame. So let's look at this first, and this is gonna be our higher time frame. Okay, so I think by now you're already very familiar with the market structure and how to map them. So as you can see here, we had this push, the pullback, the boss. So the market's making higher highs here, and still boom. And we had another boss here when we had the candle body close on both sides here. And then price reached to a certain point here in the market where it wanted to reverse. So this would be a supply area, a very strong supply area on the higher time frame, which made the market pull back. Okay, so at this time here, we had a strong low, a weak high, a strong low, a weak high. But then price to keep this as a weak high, and this is a strong, let's say this is a strong low, right? So when we had the push, remember, like this price should have pulled back and then try to push again to break this high, because the job of this low was to break that high. Okay, but like what happened? Then we had a push down, and then we had a bearish boss. So the market structure switched to bearish. Okay, so we had this low here as our strong low. And then when we had the push, and then we had another push down to a bearish, now this became a weak low, and that became a strong high. And as we continue, then we came here, boom, bearish move. Then we had a chalk to the upside, which is our first sign of a change, then a pullback, then another push. Okay, so this is our hard time frame. So it doesn't matter. You always, if you always compare like two time frames, so this would be the higher time frame. So now let's look at the multi-time frame analysis and how this would look. So let's say this is the 4 hour, right? So let's make it this example, and this is the 4 hour time frame. So I'm just gonna change here as I have it. So let's change this to
like a more faded color so you guys can see what I mean. Okay, so now I'm gonna be teaching you guys how to read the multi-time frame analysis. Okay, multi-time frame, not analysis, but okay. I changed the colors of the higher time frame, the 4 hour, to a more faded black, so we can now start to take a look at the lower time frame. So let's think that this white one is the 15-minute or a lower time frame. Okay, so it doesn't matter, but let's say this is the 15-minute. All right, so as we are pushing up, remember, like a run, run, run. So this is a run. Okay, so what is a run? A run on the higher time frame is a trend on the lower time frame. So this would be a run, and this would be a run, a run, a run. Okay, so as you can see, like when we see a push on the higher time frame, which in this case would be the 4 hour, we would then, if we drop to the 15-minute, then we would see price trending up to create the push that we see on the 4 hour. It's kind of the same as we were seeing on the market structure for swing structure and the internal structure. But so as you can see here, so price was trending up. Then we had a chalk to switch price to a bearish state here on the lower time frame. And then as you can see, the change on the 15-minute, the first chalk and a change, it could be like an internal change or just a bearish chalk here. But the main thing you need to understand is that the higher time frame is more important than the lower time frame. So the daily will be more important than the 4 hour, and the 4 hour will be more important than the 15-minute. Okay, so here, right, we had this push, a run, and a run. And like, if you remember about our market structure, how does the market move? By pushing, pull back, pushing, pull back until it fails. So we always expect that it's gonna push and pull back to break the recent high or the recent low if we are on a bearish move. Okay, but here, right, so you can see that price only changed the lower time frame only changed to bearish for the higher time frame, for the pullback of the higher time frame. Okay, so that's why a lot of people get confused about the direction, and they can't read the market, and they can't read the direction of the market, right? And they get stuck, and that's sometimes we call you got caught in the wrong you got caught in the wrong side of the market. So that's what we mean, we professional traders, when we say that. It's because you're thinking that this is going down, and this is gonna go all the way down here, but you gotta understand that the higher time frame is more important, like I said. And this change here was just to facilitate the pullback on the higher time frame to come here. And we're gonna talk about the demand and supply, just to mitigate something here, and then to do another push. Okay, so I hope you understand this little part. And as we keep going, the market still do the same thing. The lower time frame came here, it pulled back to do the pullback on the 4 hour now. And again, right, this is a weak high, and this is the strong low. So the job of the strong low is to break the recent high on the lower time frame, on the higher time frame. But remember, we are just looking at the higher time frame, and then we are analyzing the lower time frame to see what it's doing. So the job of this was to break that high. So when we had the pullback, Our bias is that this was just a pullback and the lower time frame just turned bearish, so we can continue the movement. Okay, so here again, so when the pullback was complete, we changed bullish again. We had a bullish shock. Okay, and then price continue. Price continue, and then here we could have just a small, again, right? We could just have just a small reaction to the recent high, because this is a very strong resistance, but then price just reacted and continue going up. Okay, because we understand, right? Because we look at the higher time frames first, and then we know that this was just a pullback, and that's why when you're taking shorts, you got to be like more safe when you're going counter trend, because you can't take shorts from here to here somewhere, but you got to be more conscious, right, that this is a pullback. But we're gonna be going over that a little later, because we're gonna be talking about entries and stuff like that later on. Okay, again, right? So we continue to break this high, came here, same thing again, had a bearish chalk again, continue down, boom, again, right? So what was this? This was just a pullback on the 4-hour higher time frame to then what? To then continue up. Okay, like later on, we're gonna learn where price. I mean, when we have a pullback, there are certain places where I mean, not should stop, but like it's a high probability places where price could stop and mitigate, so we can continue the move up. All right. Once again, price change bearish on the lower time frame just to facilitate the pullback of the higher time frame. Okay. So again, we had a bullish chalk again. We continued up, same thing again, right? So here's the interesting part. So we had this push here again. We broke this recent high. We had a bearish chalk again, but then when we came here, like we broke all the demands that were here that was supposed to hold price to continue up. And instead, what happened? We came here, we had a pullback, then we reacted to this low, and then we reacted here, right? And then what happened? We changed the higher time frame, the 4-hour, changed bearish right here. Okay, so now, like I said, we had this as the strong low. Now after we had this change of direction to the downside, now this is our strong high, and this became our weak low. Okay, I hope you guys stay with me. And like I said, guys, this is one of the hardest parts of trading, because you can get confused in the beginning. But don't worry, like I used to be very confused about this part too, and it was hard in the beginning. But like once you get this will be mind blown. Like just stick with me. Okay? So all right. So 4-hour change bearish here. Okay. So the 15-minute, right, change bearish 2. Then we came here, pulled back, but like this was still our strong high on the lower time frame. But then we came here, price couldn't break this low, and then we pushed up. But again, right, remember that now our 4-hour structure is bearish. So this chalk that happened here on the lower time frame was what? Was just a pullback of the 4-hour. You know, like, do you see now like that everything aligns? That the price like on the lower time frame is just is just building the bigger picture for the higher time frame. So okay, so here, like you can see also that the chalk was up here because this didn't break the low. So the nearest high here was this one, not this one. Okay, if you still confused about this part, go back to our chalk fractal section so you can go over this again. Okay, so again, right? Price came back here. It couldn't break this low on the lower time frame, and then it switched bullish. But for what? It was just to mitigate something here to then continue down. So this was just a pullback on the 4-hour, and this was still strong. This was a weak low, and price should, the job of the strong point is to break the weak point. So as we can see here, he accomplished his job to break the recent low, right? Okay. So what happened here again? We had a chalk, price continued down. We knew that we could possibly be breaking this low here because price on the fire was bearish, right? And what happened here? We had a bearish boss again. And so like right here, we would be expecting price to just pull back somewhere here to continue down, right? But again, what happened? Like, yeah, we're gonna have confirmations. We're gonna use the, like I said, when you put all the time frames together, it's so much easier to create this picture, right? To tell a story of what price is doing. Okay, so like we wouldn't have a confirmation here that price is holding somewhere, like the pullback. Remember, we can use the discount and premium price, or even like we're gonna learn about the supply areas here, that like this high would have broken the supply area here, so that's why the price went up. But this is for later, so let's continue here. So again, price on the lower time frame turned bullish. But it would, on our first thought would be just that price was pulling back to continue down, but instead price broke the highs again. So now we turned bullish on the 4-hour. Okay, so again, same thing happened. Price came here, kind of wicked out on top of this one, and then we had a bearish chalk, came here, and now that we changed bullish again, price, what's gonna happen? Now we have this strong low, weak high. What is the job of this strong low? Is to break the recent high. Like after it pushed, pull back. Now the job of these two guys here is to break this recent high. And then what happened? We had a bullish chalk again. Boom. Price came to mitigate something here, and then we pushed back. I draw this example here for a reason, right? Sometimes you're gonna see that, okay, price, like, okay, right? So we had the 4-hour push, pull back. The lower time frame turned bullish after the pullback was over, and then it pushed back, right? So here, let's say you had a push, but that was a false attempt. We just closed on this trend line here with a wick, and then price pull back here. It's still like, it doesn't mean that this was a failure, right? Until we see another, like, let's say here, right? Let me draw on the side. So let's say that we had this push, and then we had a pullback here, and then we had a push. Okay, maybe if we saw a chalk or internal structure changing bearish here, okay, we could see that this was a failure to break this high, then possibly price could start coming down again. But like this was just a reaction. Like the reason that because price didn't because price failed to close above with a candle body close on the 4 hour or the 15-minute, it doesn't mean that it should go down from here. This was just a reaction to then we continue up, right? And then that's what happened. So we just had a wick here, came back to mitigate something here, and then continue up. So yeah, I know this is a little hard to understand in the beginning, but keep I think you guys should practice on the charts, like marking your high time frames, your lower time frames, and going and start to see how market is moving. You're gonna be analyzing and marking your highs, your lows, and then you start marking the lower time frames, highs and lows, the chalks, the switch of direction, and everything like that. And this you're gonna be doing every single day. You're gonna have so much practice throughout the course and throughout your trading career. That's this is one thing that I do every single day. I come to my computer, I go to the daily, then I see what's going on, and then like this would take kind of like, let's say this was the daily, right? This would take a couple days just to do this move here. So like you don't need to worry so much about that, right? So and then like just the pullback, it would take another couple days or 3-4 days, and then we had, so like if we're always following like 1 or 2 pairs max. So like you're gonna be so like aware what's going on in the market. Like when you wake up and look at the charts, you're gonna see like, okay, like it was right here yesterday, so now it's back here. Okay, I know this is trending up. This is a bullish trend, so I know that this was just a pullback. So I'm just waiting for price to turn bullish on the lower time frame, so I can look for entries somewhere down here to continue the move up. All right, and if it fails to break this high here, I know, okay, I'm not going to a FOMO. I don't know if I can say that. Okay, my English is breaking as we speak. But okay, so like price failed to break this high here, and then it turned bearish from here. Okay, this is a good indication that price might be failing to break this high, and it wants to push low now. So like we just react to what we see, and if there's no trades that day, that's it. There's no trades, and we move on. Okay, so I hope you guys got this, and let's just take a little more. Let's dive a little deeper into this, right? So again, guys, so this was the 4-hour, the black one. So in here we had the push, then price turned bearish, the structure turned bearish, came here, and then right here the job of this push, I mean when we had this push here, like we were expecting the price would just pull back to continue down. So instead, what happened? So we came here, right? We turned bearish structure, and then we pushed up again. So now let's dive a little further than that. So what happened here? That price stopped here, and then we went up again. So let me change this, and now you're gonna understand a little more. I'm just gonna do a long line like this, another line like this, another line like this. Let me change this color to maybe orange. Guys, so right here, So this is what multi-time frame analysis is. Remember, a run on a higher time frame is a trend on a lower time frame. So now let's say that this orange one is the daily. So that's why this was a push, this was just a pullback, and this was another push. So now you see like how one stack on top of the other and stack on top of the other, right? So like if we're gonna see when you start analyzing your charts, let me just put a boss. Let's see if I can do this. Right, we had a boss here. Boom. Let me change this to orange. Okay, so this now the orange one is our daily. Okay. Again, on the daily, when you go to the daily time frame, maybe you're gonna see like your lows here, your strong lows here. Then we're gonna see the week high. Then we're gonna see the pullback on the daily, and then another push. So again, right? If you're always looking at 2 time frames. If you're looking at the daily, then you're comparing the daily with the 4-hour, and the 4-hour with the 15, and the 15, and then you can jump on the 1 minute the same way. We're gonna be looking at this later. The same way we look at this on the 15 4-hour and daily, we're gonna be looking at the 1 minute. We're gonna have the chalk on the 1 minute, the break of structure, and everything else. Okay, so when you go to the daily, you're gonna be seeing this push here as price on the 4-hour is creating the trend structure, right? And then when it turned bearish, you see like right here, when it started to turn bearish, we're gonna see on the 4-hour that price failed, and then like it started to pull back down, and then we'll see that okay, so price only turned bearish on the 4-hour was just to give the pullback on the daily, right? So like I hope you guys are understanding this. So the price only changed the bearish on the 4-hour to give us the pullback on the daily. So the reason why price stopped here on the 4-hour was because this was just a pullback on the 4-hour. That's why like when it came like maybe like on the discount of the daily, or like some very very strong demand here, that's why we don't continue to take shorts. You know, like as we start learning, you'll see what I mean. But like because we know that the daily is bullish, and this was just the bearish, the 4-hour turn bearish just for the pullback to then continue the movement again. And again, if we delete the orange, same thing, right? The push we see on the 4-hour, the 15-minute turn bearish just to do the pullback of the higher time frame to then continue the move up, and we still go from there. Okay, guys, so I think that's it for now, because I think we're extending a little bit, and I'm gonna show you guys on the charts like how we can take this to the real life. And but I think this makes like so much easier to understand by using these lines first, because then when we jump to the charts, to the candles, you understand what I mean. And so on the next video, I'll show you exactly how I analyze the market when I got to my computer first thing in the morning every single day, and you're gonna be practicing this every day, like I said. So go over this as many times as you can, because this, like I said, this you're gonna be looking at this every single day, and you're gonna be practicing every single day. And by the end of the course, we're gonna have some homework for you to do, right? So just wait on that one, And let's continue on the next video.
All right, so let's continue with our practice on multi-time frame analysis. And now let's jump to the charts. Yeah, so this is gonna be the real thing now on the charts with the candles and everything. So let's start here. Like I said on the previous video, we start the analysis from the higher time frame going to the lower time frame. So this is exactly how I do it every morning, every day, for the analysis for the pair I'm gonna be trading for that day. Okay, so just to have some previous like history here on how the market was moving. So we had this push here, and then the swing pulled back, right? And then we had a break with the candle close like on top of this high. So this was the I would say this is swing too. So this was a strong and a weak, strong low, weak high. Then a push, pull back. So this was still a strong low, weak high. And then we had the push. Then this became our strong low. And when price pushed again, it was supposed to be price was supposed to stop somewhere here for the pullback, and then this push tried to break the recent high, and then it couldn't. So this is one of the things too, right guys, because it's not only market structure, but you also need to look at price action. So what is price doing, where it stopped, what it tried to do and couldn't accomplish. So in this very good example here, right? So price stopped here at this demand, then it tried to push to break this high and it couldn't. So, and what happened after that? We had a break. I mean, not a break. We had a pushback again. And again, right? Like if price just came here and mitigated on something else and it continued, it could have done this, right? And continue up. But in this case, it broke down with the candle body closure below the lows. So before this low here was the strong low, and that was the weak high. But after the closure here, now this became the strong high and this became the weak low. So on the daily, the swing structure became bearish. Okay. Remember like how price moves: push, pull back, push. Came back, pull back, try to break, couldn't break, and then push down. And so what's gonna happen again? Same thing: push, pull back, push, until price fails to break. Okay, so this was too small of a structure for us to set as our swing. I don't really map my dailies on like the internal structure of the daily, because I don't think it's necessary, but you could if you wanted. So let's continue just with the swing to make it easier for us, so I can explain it better for you guys. So like after this push here, right? So just a quick note here, guys, and I think you guys will be seeing on this example. That's why it's always better to go pro trend. Like let's say here now, right? We had this push. So that's why it's always good to go pro trend, because it doesn't mean that because it broke down here that it's supposed to pull back. Price doesn't need to do anything, you know. So that's why it's always more higher probability to continue with the trend. You see, even on the smaller time frame, on the internal structure,
you can see that price was bearish here. So yeah, because like I said, like you can see here, the price pulled back, but it doesn't need to, because if we use the discount and premium price, let me change this thing to the, let's say here, yeah, you see, so here would be the premium price of this swing move if we mark this, right? But as you can see, price didn't go all the way up there. You could price, like after that push, it could continue like going until then it fails and then it wants to pull back. Okay, so let's continue here. Now we have, after this push, now this was a more significant pullback for us to mark this as our strong low. I mean, sorry. Yeah, so strong high and then we had the pullback. Yeah, no, now we had this weak low. Sorry about that. And okay, and now we have this strong high here. Okay, so same thing, right? So what do we expect? Price to pull back, and this high should be protected until we see a bigger change, which means this would switch bullish, and then we would maybe start seeing like a switch of direction, and maybe it coming all the way up here. We're not gonna be going to the weekly, but this, like as you can see, that it's a very big push. So this would probably be like a weekly push and then a weekly pullback. But let's continue here on the daily. So okay, again, so we have this daily strong, right? So let's continue. Let's play this and see what's gonna happen. Okay, so now remember, for us to, we had a chalk here somewhere. Let's see, this, I would mark this one here as our chalk up, daily chalk. Let's see, where is it? Sorry guys, I changed this thing here, now it's all over the place. So we had this the daily chalk, right? So again, right, so what is the chalk means? The chalk is the first sign that it probably would want to pull back, but sometimes it just wants to pull back to stop somewhere here, and then it goes down. So here, right, we had this push, and so far we only had the wick. And so when we talk about multi-timeframe analysis, guys, like when you see like small structures like this on the lower time frame, like you don't need, sometimes you don't even need to go to the lower time frame to know that this is that this would be like a 4-hour swing, right, on the lower time frame. Because like you're gonna, like as you start trading and analyzing your pairs every day, you see like when price is doing like a bigger move like this on the daily, right? So you see that here price on the 4-hour would have changed bullish for a little bit to come here, then change bearish and continue. So like just by looking at the daily, you can see that. But again, like because we had this switch of direction to the swing on the daily to switch bearish, we expect that price will continue bearish until we see a very like a bigger like switch of direction, and then we start making higher highs, which will be like a bigger pullback. But so far, because our daily is still bearish, we only had this pullback here. We had a break. We could mark this, let's see. We could mark this low here as our swing low now, because it was a very good pullback. So let's see what's happening on the lower time frame.
Let's go to the 4-hour. Okay, even on the 4-hour, you can see that we had this, you see like how big the push was to the upside, and we had the chalk was all the way down here. You see that like on the daily, we saw that the chalk was up here, but when you see that price on, let's say on the daily, right, when it comes here and it start pulling back, you usually gonna see on the lower time frame, in this case would be on the 4-hour, you're gonna see the chalk all the way down here on the 4-hour, but maybe sometimes the daily chalk will be kind of like somewhere up here, you know, because like price would usually like do something like this, and then the chalk will be here. But the reversal, it starts on the lower time frame, and then it will be like doing a small structure and then switch bullish here, and then you'll see that this is gonna be the higher time frame pullback. Okay, so let's go back there. 4-hour, right? So we're still here. We still protected because the daily, it's still that strong daily, which is this orange line here, and so far price just wicked that high and it hasn't closed above. So let's continue again, right? So price continued to push like nothing yet, and then we die it down. So let's see how it looks on the 15-minute. So here, guys, you see, like, let's say you guys had your bullish structure here on the 15. Okay, so you probably would have, let me mark this, like the bullish 15 would be kind of like this, and then you would have like here. I'm just giving like some examples and like showing you in real time how I would be looking at this. And this is a very good example. Instead of going with like very specific examples, I want to show you guys more complex examples, which like I think you guys need to learn first, because then the easy ones, which what other people like to teach, because they show you the best scenarios, you know. So I want to show you the hardest scenarios, because when you see a more complex, I mean, when you see the easier to spot complex, then it will be easy for you to, when you understand the complex, then the basic and easy will be easier. So I hope you understand what I mean. Okay, so here, right? Remember, like just by seeing the waves, remember what I told you guys before. This would be like a small structure. Then we see the swing structure. So like this would be kind of like a swing. This would be like internal structure, another swing, another push. Okay. Okay, let's so mark this up here. And then what after this push on the 15, what is the lowest lowest place where price went before the push? So this would be it. So after we had this break here, so this was the lowest part of the pullback, right, of the swing on the 15-minute. So right here, this is what I want to teach you guys. So this is very important. Right here, right? This is the price on the 15-minute swing. It turned bullish here. So this is very important for you guys to understand, because remember that this is the strong high on the daily. Remember? Let me go back there for you guys to see. Like we are right here on the 15-minute.
Let me change that to the 15-minute. Dark. Okay. Right. We are right here. So as you can see on the 15-minute, price turned bullish on top of that, the line. But like after that happened, what happened? We had a push down. So I need you guys to understand this, the multi-time analysis, because we start from the higher time frame, which is the most important one. Then we go and lower to the lower time frame, right? On the 4-hour, we also didn't close above. We just had like this wick, and it was kind of volatile here. So it's like I would probably not be doing much here because it looks like very choppy and nothing really happened. Maybe it was news or something like that, or depend on the time where this happened. So like right here, guys. So when you see that, okay, price wants to continue going up because it turned bullish on the 15. But remember, like when you see something like this, like you go to the 4-hour and see, oh, like what's going on here? Like, okay, price just wicked above, and like which one is more is stronger, the higher time frame or the lower time frame? The higher time frame. So like when you see that price, okay, it turned bullish on the 15-minute swing, but it just wicked out on the higher time frame. You already know, okay, like I need more confirmation that this wants to continue going up. So like you don't do anything. And that's why, like when you saw that even though price turned bullish here, then we saw that it just wicked on the daily and the 4-hour. Then price again, it turned bearish here. You see? So the price only turned bullish on top of that just to try to break the high there, but this is we are talking about a higher time frame structure, so it only wicked out there, and here it closed above just to try to break the highs or maybe sweep liquidity, which we're gonna learn later, and then right away it pushed down again and switched bearish, aligning with the daily and the 4-hour. So I hope you guys understand this part, and I think the more we analyze every day, I think you guys will be getting this more with the practice on the daily. As we practice daily and we look at the same pair every day, you guys gonna get a sense of how the market's moving, and it's gonna be easier for you guys. So let's continue so we can see some more examples how we can use the different time frames to create a story like on the movement on the market. So let's continue to push down here. Okay, so here, right? Remember what happened? Even though we had a chalk, even though price turned bearish here on the daily, then we pushed up. We never closed above this on the daily and the 4-hour. And like I said, guys, like it didn't go all the way up to pull back on this to this swing here. So, and you see like sometimes the movements will be larger on the higher time frame. Like look how big this is, but because like price was very bullish here, so like this was still our low and that was still our high, you know. So like look the difference on this move and this smaller move. Okay, so now, right, so now we have this low here protected, and then what happened now? So again, right, we had this push, the pullback, and now another push. So after we had price break below and with a body closure below this recent low, now our strong high, I mean this was gonna be our strong high. So we're gonna just copy, of course that's gonna happen, right? So we're gonna copy this guy here, and that was the highest area price went before the break. So this is now our strong high. Okay, so as price continues, boom, like right here, right? What is our nearest high? This would be the nearest high if we are to have a chalk on the bullish chalk, but only when price breaks above that we're gonna have a chalk. I'll just leave this here in case so we can continue to see. Okay, nothing happened. We had a break again. We had a bearish pause again. Boom, continue. Okay, so nothing happened here. I'll just move this to the side. And then we had a bearish pause. Oops, what did I do? Okay. And the bearish, and these are strong high. Okay, we continue like that. I just want to keep playing because I want to show you guys an example. Okay, right here, right? Again, guys, we're gonna learn this later because we're looking at, because when we're looking, even though we're looking at just the swings, the fractal is very important too, so we can expect the change, the switch of direction. Let me change this to the here. So as you can see here, like price, we had a pullback here, and then price came all the way down here, and we had, let's see if this breaks. So you can see that like here 09334, and that is 09364. Let me see if I'm seeing this right. I'm gonna look at here at the OHSL. Okay, 09334 and 09364. So you can see that we had a break of this recent high here. So like that, we had a chalk in a sense, but that's why I'm saying like that a chalk is just a little signal. You cannot just go like with the chalk to expect price to pull back, because it doesn't always need to do like this, come here, oh no, now we have a chalk, like we're gonna take longs from here up. No, we need to understand that price is still bearish, and maybe this is just a sweep of liquidity, which price is grabbing orders on top of this high here, just to continue down as it did, right? So let's continue. Okay, boom, price still, this is too small of a price action to be a swing. Let's see what happened. Okay, price reacted to these highs here, and then we had a chalk. Okay, we had a chalk here, right? Where is this? Oh, there you go. Now we can use this guy. Okay, so now we had a chalk here. So remember, guys, like I said, when you see, even if you see smaller structure on the data like this, you're gonna see like price, maybe this is a swing on the 4 hour or the 15, even like a bigger structure on the 15. And when you see price like chalk, like in this case, right, we had a chalk bullish on the daily. On the 4 hour, you'll see like price, we had a swing, and then it pushed down, it had a bearish pause, and it changed the direction with a swing bullish here, and this would look like this on the daily, and we would have a bigger structure on the 4 hour. So let's see how it looks there. Remember, we had a bullish chalk to the upside. Our swing on the daily is still bearish, so we are expecting price only to come back somewhere up here, like maybe to this supply, or maybe we can use our discount price too, and discount and premium price. This would be the EQ of this move. Let's say, let me use the main here. Okay, so even like right here, right? We're gonna learn this later, but this is like a sell to buy supply area. We don't need to worry about that right now, but you can see that here is the 50% area of this swing move. So let's go to the 4 hour. Remember what I said? So here, right? Sorry that I'm having to grab this stuff here on the fly. Okay, we have boom, price had a swing bearish move, which would be here. Change price boss. Okay. And then what happened? Remember, this is the strong daily high, and this will be the daily week low now. But on the 4 hour, you can see that we had the strong high, week low, strong high, week low. This price was supposed just to come here to pull back here, but like what happened? Instead of doing this to continue on the daily, it came here and then it broke to the upside. So price is switching bullish on the 4 hour to facilitate the pullback on the daily. Okay, so I hope you guys understand. So now that we know this, we know that we're not gonna push price too much on the daily, since we know that we're expecting price to maybe, like I said, it's like comes to some supply here, or now we are hitting the EQ of the bearish on the daily. So price could just stop here to continue the move down, and this switching price, this switch in the swing price action was just to help price pull back on the daily. So let's see what's happening on the 15th. Same thing, right? Look at that. I'm just gonna mark here, guys, so make it easier for you. You see, we had a push. Now we had this strong high. Now we had the push again, and then price pushed up, breaking this high, which it looks pretty similar to the 4 hour. So if you wanted to take longs, maybe if you had like a very strong demand here, but you know that price just wants to do a pullback on the daily. So okay, now I see that price is getting close to the EQ, which is like almost the 50% of that move. So it's the premium zone of that strong push. So price anytime here, if I'm looking at the daily, anytime here price can just be switching again. It will switch. Let me just grab this, and So I'm just gonna do the 15 minutes boss. And then again, right, it looks pretty similar to the 4 hour. Of course, that's not gonna, what's happening? It doesn't want to glue to the top one there. Oh, there you go. Okay, guys. So actually, it should be this one. Okay, so push, pull back, push. Okay, boom. Price pushed up. So we could maybe wait for price to come back here and probably like do a little pullback to then continue up, and then like do a little pullback. And then when it's time that the pullback on the daily is done, we would be see like a push down, maybe a pullback, and then we would like start to making lower lows on the 15, the 4 hour, and all of that. So let's see, let's play price here to see what's going on. You see, like it takes more time on the 4 hour, but look, let's see how it looks on the daily. Like you see, like how it respects the 15-minute push on the daily as well. You see, like to the pip here. I mean, not to the pip, but it came to this zone here. So you like you can be using the discount and premium price just to see where we are, and like when price switch bullish here, you know that this is just a pullback. And you could even set this as a internal structure, because that's the swing, and this is the struct, and this is the internal, and price switch bullish on the internal just to do the pullback, and then it would push down again. So all this time, remember that the swing, that's what I do when I'm trading. Like first thing, okay, how is the daily? It's bearish. Okay, so how is the bullish? Where it is? Where is price according to the 4 hour and daily? Okay, so it's finishing the pullback. Like what is it doing now? So like if we see here, right? Price came here. I'm just gonna put this here because this is like a supply that we're gonna be learning. And then, okay, what happened? So this is the swing, price pullback, made a, you can see that this is a fractal. Now we had a, I'm just gonna grab this guy. Now we had a bearish chalk. So you see, first signal was a bullish chalk to signal you guys that price would start the pullback. Then when it was done with the pullback, then price signal with a bearish chalk, like that, to showing you that possibly the pullback was done. And then it broke, gave a bearish pullback. Let me draw this. Came here, pull. Remember what I said in the beginning, right? So like even here on the daily, just by looking at this, the fractal on the daily would be a larger movement on the 4 hour. But just here, like I don't even need to go to the 4 hour right now. Just here, right? Just by looking at the daily, because it's even easier to see because it's less candles. Like the 4 hour would probably look like something like that. Oh, sorry about that. Something like big like this, and then it would push, and then it would think that price would still try to go up, but we already know that this is a pullback. So like it's even less candles and it's easier to spot. So price here, right? It came here, it pulled back, it mitigated this supply, and then we had a bearish chalk. So after here, right? So price changed to bearish. So like we started the bearish movement from here to then continue down. Okay, So like you see how it easier it is to spot. Let me see if we can see it better. Let's see. Yeah, right. Even like this. So we'll probably like have my daily swing here, and then oops, sorry. Then we had the low here, and then we had the high there. Also this guy. Okay, like push, pull back. It came here to this. You would probably see as a daily, a 4-hour chalk, but this was just a sweep of liquidity below here. Then price pushed up again, and then we came here. We reacted to a demand here. Then let me see if this breaks up below that. Yeah, you see, like just if price close just a little bit below that, that's already a switch of a swing structure to the downside. So this swing switched bearish here, which you see like how everything aligns. Like the 4-hour is aligning on the daily, but the daily, it will probably be easier for you to spot. Look, like little pullback, push, bearish. So you would expect price to come back here to make a lower low, lower high, to then continue down. And then, okay, so which one? Where is your target? I mean, you would have another targets inside here on the 4-hour or maybe the 15, but you know that this is the wick low. So if that is only the pullback, this should be your target, because that's the wick low. I'm not saying that you need to hold all the way from here to there, but you would probably be taking shorts somewhere here and then somewhere here, and then okay, now I'm gonna be a little sorry. Let me play this back. Okay, let me just. So now I'm gonna be a little more cautious, because price can maybe just fail to continue down here, and probably you could start doing this. But as long as price don't switch, we still have our bias as the daily is bearish, right? So let's see what happens. Okay, you see we had a reaction. It doesn't mean that this is gonna this is gonna turn bullish just because we had a reaction, right? And then let's see. Okay, you see that? And again, right? And you start to see that when we had this bearish move here, pulled back, see how powerful this move was. So like for us to have a a bullish chalk, it would have to go all the way up here to break this high. But instead it just reacted, because this is a strong area, because this was the low where price reacted to start the pullback. So it just reacted, and then it continued down again. And price continues on the 4-hour again. You see, boom, price continues there, and then this will be same thing over and over and over again. Push, pull back, push, and now we would have that as our high, and we continue. Price on the daily, we would see that price broke here. You see that was the push on the daily. Price only switched bullish on the 4-hour to come pull back here. It doesn't need to go all the way up there, as you can see. Price then turned bearish, then just pull back to mitigate something here, respected this strong high on the 4-hour, and then it continued with the move down, breaking this daily, which here will be the daily low. Let's say that. Okay, So I hope you guys get some the sense and how everything moves and price. Like once you start stacking like one price action, sorry, one market structure on top of the other, one time frame on top of the other, you start like uh picturing like better how everything is moving. And this is, guys, like, because I'm playing back just to show you guys some like some very good examples, like some, like I showed you the failure to break the highs, and now I showed you guys that price just came to pull back here. But like once you are on the live market, you can see that each candle here is one whole day. You know, we're right. We're here, right? Like this is gonna take 1, 2, 3, almost like 1 week or 2 weeks for this to happen. So like you only need to, okay, you spot something here on the daily. Okay, so price is approaching the pool. Price is approaching a very strong area here, or like let's say we're here, right? So price just gave us the first sign that it wants to pull back. So okay, so the EQ is all the way up there. We had this supply here, which, like I said, we're gonna learn later. We still we could be pulling back. So like we had all these days here to look for longs, knowing that this was just a pullback. It doesn't mean because this is a pullback and price is bearish on the daily that we only gonna take short here. Of course, it's always better to go with order flow and like continue with price action. But like when you go here, okay, we had the 4 hour, the daily chalk to the upside. Then okay, price now switch bullish to the upside. Okay, maybe let me see. Yeah, later on you're gonna see that like one goes on top of the other. We had a big movement here, but like here probably price we would have a chalk to the upside here. Price maybe came to mitigate something, and then you start like, okay, I'm taking longs until price like reach the like maybe the EQ or like the daily or the 4 hour supply. Then okay, now I'm gonna be a little more aware that price wants to just to mitigate that, then continue the move down. Okay. All right, guys. So this is a little more complex, but as we start learning and practicing, you see how everything aligns, and everything will start to make sense. But I believe that this is just to give you guys some good examples and teach you guys the concept, but nothing's better than practice. Like I remember studying this in the beginning. It was kind of hard because like, okay, like how do I put all these time frames together? But you see, like once you start doing daily swing and then 4 hour swing structure, and then you start, okay, on the 15 I'll do the swing, the internal, the chalks, and then like, okay, now I know where we are. Now I know that I only have this move here to take longs and that move to take shorts, and you go from there. Okay, guys, so again, if you guys have any question like about this section here, I'll try to if you guys have any like specific question, I'll try to make another video or answer it or go a little deeper into the teaching to help you guys to understand this a little more. And let me know in the comment section if you guys have any question. Thanks so much, and I'll see you on the next video.
The exchange rate for a currency is determined by the supply and demand of that particular currency in the Forex market. The supply represents the number of assets that are available to be bought, and the demand is the quantity of that asset that people are willing to buy. When there's a greater demand for a particular currency than the supply, its price will increase as buyers outbid each other. On the contrary, when there's more supply than demand, the price decreases. The charts show this constant exchange of orders that happens all day long. The charts usually show balanced transactions until you see some big imbalances. The spikes you see in price are made by large institutions placing orders in the market. So it takes massive amounts of money to move a single pip in the market. So as you may already know, you and I are not able to make the waves in this trillion-dollar ocean. We need to wait for these waves of orders and catch them when it's time. These orders are placed at key levels in the market. So our job is to find and map where the big players are placing their orders so we can use them as point of interest. Just to recap what I mentioned in the supply and demand overview section, which is really important to understand supply and demand mapping. So first, there is a constant exchange of orders between buyers and sellers. The imbalanced spike of orders is generated by large institutions that use a combination of fundamental and technical algorithms to decide on the strength of a currency. Based on all of this information collected, orders are placed on the market which leave traces and can be clearly visible on the charts. We always need to have in the back of our mind that for price to move, orders need to be filled. So whoever is placing these orders are always looking for liquidity in the market. They need to use liquidity to fill their orders to make the market move. When looking to map strong zones, we're looking at places where price previously reacted to a zone, also called the flip. There was a breakup structure, had a liquidity sweep or inducement, which we will go over in the next lesson. We will be using the flip analysis in all of the time frames, including on the 1 minute for entries. So it's very important to understand this concept as well. A flip is a reaction to an important resistance level that will lead to the price breaking through or reversing from it. So if the price just breaks through a level without reacting to it, that means that the zone is not important enough, so we don't need to map them. So if sometimes you see me marking a zone and then later I delete it, it's because it's unnecessary to leave those zones on the chart because there was no reaction to it. As I mentioned before, we use multi-timeframe analysis to understand the bigger picture of the charts, but it can also be used to spot strong zones. First, let's understand the basics of multi-time frame. So 1 week candle equals to 5 daily candles. 1 daily candle has 5 4-hour candles and so on. So when mapping our zones, we also start painting the picture from the higher to small time frames. It's similar to the Russian stacking dolls. We will map zones inside of the zones until we find our precise point of interest. For example, we will map 1 daily candle zone, and when we drop to the 4-hour time frame, we can refine our zone to a more specific area. And as we start looking at the 15-minute time frame, we can spot a range that simply means that there's been an accumulation of orders. And inside this range, we'll be able to refine even more our zones to create our entry areas or points of interest. With the multi-time frame zones in mind, let's see how we can start creating these zones. So again, what are we looking for? Reaction zones and zones that break structure. These zones will be seen on the charts in form of a single candle, which can also be refined to body and wick or just wicks, depending on the size, inside bars, and buy to sell or sell to buy ranges. These supply and demand zones can be seen everywhere in the market, so mapping the right zones will also be a skill you'll get it with time. You will see that if you mark every single zone on the charts, it will make your charts look like a war zone and probably get in the way of you making the right analysis. So it's our job as technical traders to find which one of these zones makes sense to create a trade idea around it. We need to gather all confluences in our favor, like trend direction, Is the price reacting to the zone for a continuation or a reversal? Discount or premium areas, where is price related to structure? And most importantly, liquidity. So next, we'll explore the liquidity theory and its application in refinery zones. All right, guys, here we are with another practice on the lines. And this time, so we're gonna look at supply and demand zones. This is a very nice practice because I really I really enjoy when I learn this about like supply and demand zones and the whole concept. It totally like made sense for me, and especially because I was already trading before, and I was like, why didn't I learn this before? So I'm glad I did. So I'll teach you uh, everything I know. So let's go. So first of all, right? So we're just using the lines here first, but we can see that we are having like some swing moves in the market: push, pull back, push, pull back. Yeah, you must have been tired of this already, of the structure sections. But yeah, so we're looking at a bearish move, bearish momentum trend on the and the swing price action is bearish. So as I was talking on the overview on the intro section for the supply and demand, we use historical data to map our supply and demand zones. So what does that mean? Like this zone you see here, like back then, somewhere back in history, there was there was a reaction to this price area, this zone. So like back then, if we moved all the way back there, we would see some type of reaction like this, even if it was like a bullish move, and then we would see some reaction to this area. So that's why price reacted to here. Moves pretty fast, like leaving the traces, the spikes that you see on the market, you know. So first thing, how we spot these zones on the charts. So first of all, we're gonna be looking at like flips, right? So flip simply mean that there was a reaction to an area, you know. So like if price was going up here, you know, so each time like price reacts, that this is a flip. So like there was a flip, a reaction, and then that zone failed, right? So the same thing happened here. So price reacted to the zone, and then so the same thing happened here. So price reacted to the zone, and then it grabbed liquidity on top here, which we're gonna be learning on the next section about liquidity, inducement, and sweeps. So it came here and swept this high, grabbed liquidity here, which is like grabbing orders to fill the big orders here, and then at this time here, price grabbed all the orders that it was like sufficient orders to make this move happen, right? So like we were here, we had like a small reaction, then we had another reaction, and then we had a break. So what are we looking for when we are placing zones? So you're looking for like areas where price reacted and there was a break, right? If price just came here and broke like this, I would delete this zone because there wasn't enough like orders and there was enough like orders here
and liquidity for price like to hold inside here and then react to it. So like this wouldn't be like a high probability zone for me to have it here. Okay, so continuing here again, sorry, price push down and then it react to this other demand. So when we are on a bearish trend, then we are reacting to demand, and when it turn up, so we will see like a supply here, then maybe we're gonna have a reaction, another supply, and so on, right? So as of right now, price, we would say that supply is in control. Why? Because like we are in a bearish trend. So like supply is still in control. So here, right? Same thing. So price came here and reacted to this. And the reason because price didn't so after the reaction, we had this break below the zone, which means that there wasn't enough orders here for demand to hold this area and to this for this demand to be respected and push price up again. So like we could even like have reacted to it and price could have come like just inside this zone here, and then we would be like seeing like another move up. But instead we had a reaction and there wasn't enough orders and price couldn't hold like this zone, this demand zone couldn't hold price, and then we had a failure, right? So we had a flip and then a failure. So here we had, so now we're gonna start looking at like placing our zones, right? So first of all here, because we had a reaction and then we had like a sweep of liquidity, I'll just place this one here so you guys can see it. So we haven't studied the sweeps yet, but I'll just put it here so when you guys see it next time. Okay, so here, right? Now we have a supply area here. Oops, that color sucks. Let me just put it. Okay, so right. Okay, right? So after we had a reaction, price came here, swept this high, then we pushed down. So we had a reaction and a break of structure. This demand zone failed. So now we have this supply area. Okay, so same thing, another reaction, price was ranging here, then we had a break. So this demand zone failed to hold price. So like when you see me going over the analysis, and when I said that like demand, like this demand wasn't respected, or like it couldn't hold, it's because there was a break. Even if it was just like a pip here below, I would already see this as a failure, right? So like I would just like ignore this zone. Like this is not a zone I want to be looking at for longs anymore. Okay, so again, so we had like this reaction, then the break. So right now, every time that price make the push that breaks structure, we're gonna be looking for the zone, like the zone here, the newest zones and points of interest. It's where like the big orders were placed that cause price to break the structure or the zones, right? So here, right, we came here to this demand and we were ranging for all this time. So like we were collecting orders for all this time, but right here, so like all the collection of orders and liquidity, price, whatever, money, whatever you want to call it, right here we saw that there was an imbalance, and you could see the spike in price came from here, this point here exactly, right? It could also have come here first and then come here, and then you would see the break here, and you would mark this as the imbalance, because this is where the we saw the spike coming from. So this is where it originated. All right. So right here again, we would have another supply area, and you can see, right, like it's still like, now that we learned the market structure, you can still see like the push, the pullback, push, pullback, push, pullback. And that's what I said. I don't remember which one of the sections that I said that, but like, you need to be paying attention where price stopped. It wasn't just like whatever that it stopped right here. There was a reason. Like, there was orders, money, liquidity, like institutions, large institutions. They saw that this was an area that where was like a lot of orders here, that price react to it. And like, a lot of people would think, oh, this is going up, but remember, we are gathering data, we're stacking confluence. Like, price, the swings are on a bearish move, and like, even though this could be a chalk, right, remember, so this could be a chalk, but remember, like, stacking confluences, this is still on a swing bearish move. Okay, so later on, I'll teach you and I'll tell you exactly what I mean about this, because like, if you remember, I was telling you guys that this would be a chalk, right? But like, there's a difference between a chalk and a sweep of liquidity, and we're gonna see this later. So continuing here, we had the price, this area here, somewhere inside here, there was enough orders that push price. Then we had a break and a failure. This demand couldn't hold. Then we pulled back here, right? So right here, later on, we're also gonna learn that right here, we would be looking for like 1 minute entries or risky entries. And then we could take, because we saw that price came from here, pulled back, and then we would look for a shorts on this area. Okay, so boom, again, price came here. It didn't react to the zone, but it just like it just reacted. Sometimes price, like, it's gonna be that this is a very good example that I just thought of because price will be like just going up, right? Like, price will start moving, but like, there's this point, there's this really strong areas where we need to be looking for these reactions and reversals, right? Like, this wasn't enough order. This was not strong enough to make price reverse, right? So it just reacted and broke. But like, let's say, for example, here, right? I put this as a strong zone. So let's say that at this time here, this was a very strong zone, which made price give us a chalk up, right? Let me grab this guy here. So right here we had a chalk. Okay. So chalk here. So the same thing, right? Now what happened? Because this was chalk, now we have this demand, a new demand here, because price, even though this is a fractal structure break to the upside, price, it broke something, right? Maybe on the lower time frame, the 15-minute or 1 minute, there would be a reaction here, but it doesn't have to, because this is the first push to maybe just come back here. Remember, right? We are on the swing bearish move, so like, this can be like just the daily push, and this would be the 4 hours lower lows, lower highs, right? So here, right? Remember, what is the chalk? The first signal that price may change. So after we saw this here, we could see like a new demand here. I mean, we would be mapping these as a new demand here, because price reacted to a strong zone, and then we had a change of direction. Okay, so I'll just be marking now the new zones that we found. Okay, the first one is already marked, and the second one, after price came here, right, broke, pulled back, and broke again. So now we have another supply area right here, because this was already mitigated. So if we think about it, every time there's a push and there's a pullback, so like when price comes to and enter these zones, we call that it was mitigated, right? So every time like price came here, oh, it mitigated this zone already. So like price, we made a push, pulled back, and it mitigated this supply. So what is the new supply since this was already touched, mitigated? Okay, so this is the new supply because it came here and then now it's making a supply chain. All right. Okay, so I will start playing this. Let me just change the color of this guy here. Okay, I'll just change it to the green to make it easier to see. Okay. All right, guys. So I hope you guys are staying with me, and later on I will show you guys what you will be seeing on these areas that made the push. So okay, so you had the chalk here. Now we have a fresh demand zone, which okay. So like now we could wait to see if price will come back here, if it will react to this, if we're on the higher time frame, maybe the 4-hour or the 15, then we're gonna go to the lower time frame to see what's gonna happen, if the price will be respected, if this demand will hold price to make price go up from here, right? So let's say that like we're on the 4 hours here, and then we had a chalk to the upside, price came to pull back to this demand, and then price and this demand held the price. Okay, so after this we came back here. So let's say that yeah, price didn't get to there. Price, we had this zone here, but price just came, like made a small reaction here, and it just broke. Boom. Okay, so like what are we gonna do here? So like there was no reaction, there was no flip, which like there was no reaction to the zone, and price just broke through, right? So like we're not gonna be using this anymore. We can leave this area here if you want, but remember, right? Like on the higher time frame, maybe the daily, this is still just a big push, and price might just be switching to the internal bullish to come pull back. Remember, push, pull back. So it might just be like switching to a bullish state inside this, just to mitigate a supply zone to then turn bearish again. So let's continue playing. Maybe then here we would have another demand here. Boom. And so this we would have to see, because price stopped here, right? So maybe that was another like demand all the way behind, but I would also just mark this to make sure that if we're targeting, like we're entering shorts from here, then we would target these like 4-hour zone, for example, right? Let's say that we are on the 4-hour. Okay, so now we have this 4-hour demand, and guys, I'm just doing this as I go. I didn't plan how I'm mapping these zones and how price is moving. I'm just reacting to what I'm seeing, right? So like this, like I just made it up that price wouldn't go to all the way up there, because sometimes it doesn't. And that's what I would do. Like I would just like not even pay attention to this zone. It just broke through and there was no reaction. So price could come here again, or maybe not. Like price would like just come here, make another small. Remember, it can't just keep going, going. We're not gonna map like every single higher high. That's not it, right? We use like high probable areas where like price, like we could see the push and the pullback, and price where it really like broke structure, and like where we really saw the spikes in price that made the market move. Okay, so here again, boom, we came back here. So let's say there was a very big push. So now if we use the maybe like the discount and premium price, so now we had already the push, and the pullback of the daily is finished, right? So here, so we would see like maybe like a daily's supply, and now we're seeing the 4-hour supply. So what we are expecting here, that this last demand would hold, because like let's say that this was the high. Let me just put here. Let's let me mark this as the, like let's say that this was the daily high and this is the daily low, right? Remember, so daily high, strong high, which would be the strong high here, and the daily low, which would be the weak low. And we know, let me put this back, and we know that this is the push and that's the pullback. All right, so let's say that this was the last supply area inside of this swing daily move. So this is a very high probability area that price should be, if price is to continue the bearish move on the daily, which is the, like remember the last section that I was saying, like the higher time frame will always be more important than the lower time frame. So like let's say that this was the last supply area to make this swing move continue down. So this is a very good area for us to look for shorts and start targeting these weak lows here, right? So let's say like price came here, the 15-minute, right? So now let's just continue on the 4-hour to make it easier. So price came here, and then we just like try to break this zone again, and then price pushed down again. And then we would start, right? Like we would have a chalk here, and then we would start going down again. Boom. Let me just stop here for a second. So, all right. So let's just, because I just thought about something. So let's think that, let me see if I can do this, because I think I messed up. So let's say that price, it reacted to this zone, right? So let's say that this, when price came all the way here, before it broke the supply, there was a reaction, right? And now we have also, let me copy this guy here. Okay, so we would have a demand here now, right? So like you see guys, that price like continues like this battle, right, of between supply and demand. It like comes here, push, boom. It's like a ping pong, and it continues like moving and like going from area to area to area. And that's how you set up targets. That's how you look for reversals. That's how you see that price wants to continue because it broke and stuff like that. So let's look at this, right? So now we had price reacted to this zone. Let's change the example a little bit. So Now we had another chalk to the downside here, right? So we had another chalk to the downside. So after we had this change of direction here, we can use this new supply area. Remember, like why are we mapping this area here? Because this was the area where price pushed to break structure, which was a fractal structure in this example here. But right now we would have a fresh supply. So this that means that this supply is holding. So we are stacking the confluences, right? That because price, the swing, the 4-hour swing is bearish, the daily swing is bearish, and now we had like an internal a fractal switch, a fractal change of direction to the bearish side. So daily bearish, 4-hour swing bearish, and now we had the 4-hour fractal bearish move. Okay, so here again, this would be either you could look for later on. We're gonna be talking about the strategy, but here you could be looking for like a smaller time frame entry inside of this zone if you saw a reaction, or we could wait for the chalk first, depending how strong this move is. So like this would be even more high probability to take trades from here on this fresh supply, because we are stacking the confluence, like I said. All right, so okay guys, so this is another very good example. So now that price came here, we had the bearish chalk and everything is aligned to the bearish side, right? So every time now that you see these demands, right, here, so that means that these new demands are just gonna be reaction points. Why? Because like I said, everything is bearish. So if this is a strong zone, if this is a strong point and this is a weak point, so this should go, right? So this should be the weak area now. Like it doesn't mean that you need to you don't need to like hold. You could, but you don't need to hold price your shorts from all the way up there to all the way down here. You could maybe like if you're getting in very early and if you have the heart to hold price all the way and to hold your orders all the way down here, maybe you start taking out like half of your position here, half your position there, and then your full position here, right? Or if you want, you can just like go out here for like 10R, because our strategy is super good. That would give us like a 8 to 10 hours just to this area here. I'm just giving you guys an example, but you see what I mean, right? So like, but because like price can come here, right? Let's say you went in a short there, price can come here and have a reaction to here, So like if you're going on shorts from there to here, like it retraced half of your position. So let's say you didn't close your shorts here. So you enter here, and then like if you were 10R positive here, then you would be like 5R positive. So like, do you have the heart to be holding this position for that long? Or do you prefer just to get out here? And if there's another position here, you would enter on shorts again and stuff like that, right? So let's say, okay, now because this is a strong demand, not a strong demand, this is like a new demand. So we had another reaction, came here, maybe price just did like a small like internal structure. Then we had the another push that was just like a buy to sell area, just a small one. We came here and then we broke everything again. And now we're done. So let me put, so this would be like a daily break. Let's see. Okay, guys. So you see like how everything aligns structure with demand and supply, you know, like if you see it, right? Sometimes let's say this was creating like a flag, right? Let me just put like this. And then like let's say like this, there was a lot of like liquidity, like orders on top of this, like it was here, right? So price would come here, sweep this whole thing. Usually like people that trade the patterns, they would enter here, and then they would come here, like grab all the orders and then go down again. So I hope you understand how we map these areas and how it really help us to see like why price is reacting to like a zone, or why price stopped. Because if you're just marking your like your structure like this, and if you don't have any zones, like any area that to help you understand why price is moving the way it moved, and why it reversed from here, it makes it so difficult. Because like just price action, okay, it helps, but like looking at this looking at the zones, it makes it so much easier. And like I said, like sometimes like you want to enter on the break. Let's say like pattern traders, right? Sometimes they want to enter on the break of these equal lows here, but like price is still like inside of the zone, and it didn't, and it was respected, right? This was just a grab of liquidity to the downside, and let's say that where is it? So like people would enter on the break here, and then but like this zone like still was respected. There was not a break of this zone, so they would enter here, price would break the equal lows, and then we would have like a change direction to going up. You see? So you see like how important it is to see reactions to zones, to market structure, to like higher time frame structure, to lower time frame structure, to fractal fractal structure. You see like how everything aligns. And we haven't even got to the liquidity concept, which is another very very important tool. So just to finish this part here, we're gonna do like a quick chart review as well. But just to finish this, right? So after we had the chalk, so like supply was holding, we had this change of direction, supply was holding here, we had another push, so there would be another supply area here. So like another supply, okay. So you see here, boom, price, okay, reacted to it, just made a internal structure. It didn't go all the way up. So like we will also learn on the liquidity concept that this is creating this is creating liquidity. This area is creating like pools of orders to later on, like price will come like all the way down here to come here to sweep these orders to go down again. Oh, my drawing sucks. But again, right, because we saw that from here price we had the break, boom. So this we have another supply area here. So you see, every time we see a spike, like even if it goes like from here, then price came, there was an imbalance of orders, and price like spiked from here, right? There was like a range, and price was accumulating orders here, and then we had a break. So our demand is here. We had like a buy to sell, which is gonna be like a, well, let me try to draw this. And then we would have another candle like this. So this would be like a wick up and wick down, which in this case I did the opposite, right? It was supposed to be down first and then up, but you got the point. So like if we're going up, right? If we're going up like this, like on the higher time frame, you would see like this zone, and then on the lower time frame, on the 15, you would see like a range. But let's jump into this concept right now, because I want to show you guys something else. All right, let me just clean this up. Okay, so remember, right? So we were looking at the supply and demand zones. Let me grab this guy here because it's feeling lonely. So like we're seeing the supply and demand zones, and the zones are created when there is imbalance and the spike of orders, right? Here, we had like a spike here, we spike here, we had a spike here. Okay, like you got the point, right? So let's jump to the next chart here. Okay, so remember, right? So like where we see the spike of orders, the imbalance, the push, like the origin of the push, you see like this very nice, well done paint here that I did. So okay, so here, like when you see the price that spiked, then like you're gonna see on the charts mostly in these three ways. I think these are the only three ways. And okay, so you see the spikes originated from in a form of a single candle, which would be this, an sidebar, which would be like, remember like that I showed you guys last time, that this is a sidebar is simply like a pullback, which like on the higher time frame would look like this, in the lower time frame would look like a pullback and then a break and a buy to sell area. Okay, so let's start with the single candle, right? So the single candle, the thing that you guys need to see, I mean to learn from this here, is that the price that pushes the zone is created when like the candle, the next candle that pushed, it has to break the recent one, the previous one. Okay, so you wouldn't, let me grab this box here, you wouldn't grab like the box here. Why? Because this candle didn't break on top of that one, didn't close on top of that one, right? So you gotta have this the candle body close on top of this, right? So if you had just a wick here too, like this one didn't break on top of that, so you would have to see like a very nice push like this for you to create your zone. So instead of this one, remember, this is gonna look like shit, but so you see like this one didn't close, I mean this one did not close on top of that, so like this is not the zone. So what you're gonna do is come back here, boom. So you can see that this candle here, it broke and closed on top of this. So I hope you guys understand what I mean. And later on also we're gonna be looking at refining zones, which we could use, let's say if there was like a wick here, right? So we, oops, what did I do? So we could use like just a wick of this zone. Okay, so and then what, like we saw the spike, let's say, right? Let's just use this. We saw the spike. Okay, no, push, the pullback, and the spike came from here. Okay, And after that, we could see a price coming back here, right, to then give us an entry or a confirmation entry, and then we would see the spike again. Okay. Okay, remember, like, this is the zones that we saw on the other charts that are like where the spike is originated. Okay, next one. This is this very simple one too, which is the inside bar, which is like, it's very easy to spot because of the of the color, right? I just forgot about something here before I forget. Remember, guys, that if we had like a equal high candle here, like let's say that there was only like this push and this candle here. If we had equal highs on top of this, right? If like the candle was all the way up here, and if it was equal highs, this is an like also considered. Let's say that this whole thing here is just one candle. Sorry, I should have wrote this before. But like if this was just one candle and this was an equal high, like the whole zone will be like here, right? Because like this candle broke the candle. And remember what I told you guys on the fractal structure mapping. If like the equal highs or equal lows is the same as like this on the lower time frame, you would see like a small pullback and a push. Okay, like this inside bar is pretty easy to spot. And remember, right? Same thing that like this is this is an easier to see like price action, but sometimes we would see like a range, and then we would see like an inside bar here somewhere, and then a push. And this would also be the spot if there was one candle, one inside bar, or even like if we had like a range, maybe there was like a sell to buy, and then this would be the demand. Okay, and last one, so we can finish this. Let me just grab this guy. So this would be our zones. Okay, same thing, because like you'll see more of this type of price action when like the price is moving too fast on. You spot, it's easier to spot on the higher time frame this type of buy to sell or sell to buy. But like you see that price comes here and close with the wick, and then it comes here and goes all the way down here. Sorry, goes all the way down here, creating this zone, which on the lower time frame would be like boom, boom, boom. You see, like buy to sell, and the opposite will see. Sorry, this would be a sell to buy, and this would be a buy. You see, going up to sell. Okay, and I just drew made this paint here on the bullish side, because it's the exact same if it was on the going down. You see, if it was on the bearish move, the same thing would happen. We would have this zone here going down, the inside bar. If it's going down here, comes to break, then price could come here and comes to grab more orders inside of this demand, and then go down again, and the same as the buy to sell. Okay, so I hope you guys understand the concept. I think it made it easier for you guys to spot how to map this the supply and demand zones. And then on the next video, we're gonna just go over a little bit on the on the mapping of the charts, so, which is gonna make it even easier. Now that you guys know all of this, it's gonna make it easier for you guys to go to the charts and make your analysis. And remember, guys, it's a learning block. Every section, like from this, every section that we made, that we put together, is a learning block, and it was made like from to start from the beginning, and now you're getting more advanced with the supply and demand areas, and then you're gonna go from there. And later on, you'll see, okay, now I know market structure, I know the trend, price action, I know what a flip is, and I know how to set the zones, the supply and demand zones, which will be extremely easy to trade from there. Okay, so on the next video, we'll be going over the charts. All right, guys, so let's jump on the charts now. So now that you saw with the lights the concept and how to map, how to create the demand and supply zones, so let's take a look here on the real charts, right? So okay, so let's start here with a blank chart, and we can see that price was making lower lows. Remember, like this small structure are all like internal, and we have the swings. So here price didn't break that, so that was still the strong high, weak low. Price broke here again, and we had a pullback. So this was still the weak low, and that was the strong high after we had the break here. So boom. Okay, I'm not gonna be going all the way up there, because like we're just gonna be focusing on the like more recent price action. Like that's how you would, if you would start like today doing the analysis, like back there it doesn't matter anymore. So after we made the swing low here, after the break of this weak low, so this would be the strong high, weak low again. So price, we came here, tried to break once and it couldn't, went all the way up, and then now we had a swing low again. Okay, so let me just delete these. Okay, so let's just start with this most recent price action. So let me mark this as our swing, right? So just continue with the swing lows and the swing highs. Okay, so here price encounter a very strong demand. So if we remember our section on chalks, so we can remember that this, like when we especially when we have an inside bar, which makes it so much easier to see. So this was a pullback, then we had a fractal break. So when we broke this high here, we had a bullish chalk. Okay, so this is a very good sign that we can maybe start like see how extensive the push is. So this could be a very good sign that we could like start to see a bigger pullback. Okay, so we had the first chalk here, and but we still, right, we could. So remember, like how do we map the demand and supply zones? So it's usually with a single candle, or a buy to sell or sell to buy, or like an inside bar, right? So I want you guys to like think about like how to mark these zones the same way as the lines. Remember, like we had the push, pullback, push, pullback. Okay, so let me leave this here for a second. So like when you're marking, like remember that the next candle, like
the push came from this zone here, this area, correct? But like, remember that the next candle where the push was, like, you see like the push from here. So like this candle, let me zoom in a little more. So the candle, like this next candle, has to break below the previous candle, which would be this. So like if we mark this, for example, right, you can see that let me mark this. You can see that this next candle didn't close below this candle. So like then we move to the next candle. Okay, so now this candle, it closed below this candle. All right. So like when I was talking about like this line here, remember that like about the waves of the market, you know, like the structure, how it moves. Okay. So like even though if it's a small, I mean internal or like fractal, we gotta see the movements of the market, right? So like you can see here, like we had a pullback and then we had a break. So like if you were to mark a zone here, right? Let's say here, you wouldn't leave this the highest area here like without like marking, right? Without covering, because you always like, because you think, because you know, right? There was a push, a pullback after we had a break of this low here. So that was our most recent high. So like, so what I mean is, like you don't want, even though let's say this one had break below here, right? Like this one, but you don't want to just mark like this and leave the wick above. So like when you mark the candle, make sure that you always covering the high of the candle, no matter what. Okay. So let's continue. Let me delete this. Okay, right? So we are still on a daily bearish move. So let me also mark that this. Okay, let me mark this as. Okay, so this is our daily strong. Remember, this was the daily strong there. This was the daily strong when we had this push, the pullback. Now when we had the break here, the pullback, and the candle body closed below this low. Now the next strong point is this. Okay, so far we are still on a daily bearish trend. Okay, so like how can we map the other zones on this move? So like the first one would be here, the most like the nearest point to this move would be here. So like if since we are already on a daily bearish move, we could be taking shorts from here, right? But remember that we reached a very strong daily demand, and price is respecting this so far because we had the first signal that we might start pulling back deeper. Okay, so let's see this one. So like see this one here, right? So this one here, price came to mitigate it here, right? Like when it pulled back, it mitigated because you can see there that it broke the, I mean not broke, it pulled back to inside that box, which was this whole candle area here. So like sometimes price, just since we were talking about this, the mapping of the zones is not very straightforward like that. I think with you're gonna see why, but with time and experience, you're gonna with time, with the experience, you're gonna be able to refine your zones and know when to refine and know where to leave like the whole candles like this. So let's I'm just gonna go over like the basics, because like refinement, it's a little trickier because like I said, like price is not like straightforward like that. It doesn't really move like perfectly. So the market is always like doing like some what he wants, like I said before. So in this case, we had like a reaction to a zone here, then we pulled back to this daily supply. So this uh, the most probable area for shorts would be here if this holds, because but remember that we mitigated the demand, right? Okay, so let's keep playing. The next one would be all the way up here, right? So you see that this one didn't mitigate that. Like, even though we could also have this zone there, because this is a buy to sell. So let's just leave this for a second and see what price is gonna do. Boom. Okay, we reacted. So here we had a bullish chalk, and now we had a bearish chalk. So let's keep playing to see what's gonna happen. I'm just gonna start here with the daily so you guys can have the overall idea, like how to mark the zones. Then we're gonna be jumping to the lower time frame. Okay, so let's continue. So price, we had a bullish chalk to come. Remember, like when we have the chalk, let me just, like, it's not gonna be very visible, but let me mark the daily chalk here. Where is it? Okay, all right, daily chalk, right? Same thing, like this would be the candle that we would mark for the daily, but remember that like here it came all the way down, so we could just like cover this whole candle, right? Because like even though like this candle, it like this candle broke above this, but you see that there was a sell to buy, so we could refine it just to the body and the wick, the lowest point. And you'll see later on also, because I'm gonna be show you guys that, think about like zones inside zones, right? So like this would be like the largest area because it's the daily. Inside the daily, this sell to buy here, we're gonna have maybe another daily here. I mean, another 4 hour here, or maybe another 4 hour there. So like that's why multi-time frame analysis is so important, because it makes us like see the market and how everything is reacting a lot more clear. And another thing that you guys need to keep in mind is what I said about the chess. So like the charts and trading is kind of chess. So it's like demand against the supply, and it's this constant battle. You see, like if price comes here, try to mitigate something, then it push, come here. So like you can see that it mitigated this, then it push, come here, mitigate, then it comes here. Now it reacts because it stopped here. So it continues moving from zone to zone, right? So when we add the market structure, which is like the trends and lower lows, lower highs, and higher highs, higher lows, with the zones demand and supply, it makes it super easy for us to see what's going on. Okay, so after this chalk here to the downside, let's see. Let's just remove that one, that's fine. So we had a chalk here to the downside, right? But remember, because we had a first bullish chalk here, so this move here could be just to mitigate something here. So like if I was trading this, I would say like that price is kind of it's kind of stuck in between supply and demand. By the way, this D, it means daily, not demand. So price is kind of stuck between supply and demand. So like we could have just had this bearish shock to mitigate this, but I could still look for longs from here and shorts from there, since like we have like a lot of space to trade from. But let's continue here on the daily. Now that we had the bearish move here, we could just mark this guy. So let's continue. Okay, so these are now our new fresh, or like see here, like this candle is a little higher than that. So like even though this is the candle, like this this candle, the orange candle, doesn't break below this one, so this would be the candle, the orange. You could use all this, like everything here, but like you can just refine it to the body and then make sure that you cover that high. Because sometimes price can come just to like very close to this, but still not break the demand, the supply, and then go back here. So let's play this. Okay, boom. Okay, so now we broke to the upside, but remember, we still on the daily swing bearish, because that is still our strong high. Let's see what's gonna happen. You see, again, we came to mitigate like this area here. Later on, I'll be going over like in a little more detail how you refine, because like I said, like this is a huge candle, right? Even though that, let me see, let me put price here. So you see, like there was a reaction to the area there. We had a pullback and then we had a push, and then like this candle, it breaks this candle, breaks above that candle, but we saw that we mitigate here with this other candle, right? Because like it comes here and then like price comes all the way down here, even though it's just one move. Like you don't, like when you see that price came like and there's a candle in front of it, like before the push, so like you mark the whole zone. You could even, like, if you don't wanna refine the candle to make it safer, you could just like mark this whole thing here. You see, it still works, because it's still like you could mark like this, because we're gonna still drop to the lower time frame. Let's see what happens on the 4-hour here. So like you could still go to the lower time frame, and we would probably have, you see, like this 4-hour here, because we had a pullback and a push. So this would be a 4-hour. Okay, so 4-hour there, another 4-hour here, and see how price just reacts to this like extreme demand zone of the 4-hour. So like price came here, mitigated something inside there, and then we had a break. It broke the daily supply, which was that box. Remember that we had the D there, the daily. It came there, and then it pulled back to inside the daily zone, which we had the 4-hour demand here and the 4-hour demand here. But like you see, we could also have, you see, like the refinement. Like, see what I mean? Like, some, it's mostly if you're targeting, like, let's say you're targeting to enter a trade. Let's say you enter on a short here, right? So like if you're targeting somewhere, it's better to not refine it, and like I would go out here, because like sometimes like you can see that price already mitigated that. Let me just change. I hope you guys are understanding like what I mean about refinement. It's just like instead of using the whole candle, you refine to the body, or sometimes even like the top, the lower part here. But you saw that this part all also came down there, so I would just like mark like that, And as you can see, we had a small reaction. Even though it was small, it's still a reaction. But in this case, it didn't matter because price just broke through. So you could just like leave it like that, right? And if we read, but if we read price action, it just came here. So before it broke this high, it came here, pulled back, and then it pushed. So this was the last place before the push, the spike. Okay, so that means there was a lot of orders here that made this push go up there. Okay, so let's just continue, guys. That was just an example, like how you guys can drop from the daily to the 4 hour, and even more, like you could refine into that week. Okay, so let's continue. Like I said, that's why I said that like even the refinement of the zones is gonna come with experience, because you guys will continue seeing over and over, and you see like, oh, price is reacting to something. Oh, okay, so it doesn't want to come all the way here because this is too much refinement. Like, oh, but it could be, instead of the whole candle, it could just have come here to the body, right? Okay, so let's see, continue playing. Okay, so let's see what happened there. So price didn't react to this buy to sell, so we can just delete this one. And let's refine, let's change it to the top. Remember to use the magnet, because it kind of sticks to the top of the price. So you see that the orange one is lower than the white one. So you drag to the top there to make sure, right, that you cover the whole high of this move. Okay, so here, right, we had a reaction with remember what the orange inside bar means, that it was just a pullback. Boom, to then we had the move. Okay, so now that price broke this high, now we have this as our strong low. Okay, and now we have that like this. Okay, again, right, like push, pull back, push, try to break here, couldn't, it's still, but like it had to break that high to make the move up, but it just came here to mitigate this, and then boom. Another good example here, that is not just because price like failed to break on the first time here that it's going to go up there. So like right here, right after we had this break, we would have this daily zone, and like see where it went and stopped. So it respected this daily zone and continue. And you see like that, like even later on, it continues to do like a supply chain, and only here we had the break up. So you see like how like just by marking the zones, it makes it so much easier to understand why price stopped here, came back, right? So okay, so now that we had the swing daily switch bullish, so like where do we mark now? Okay, so we have this extreme one here. So this extreme demand, because it's following all of this demand, this was the last point where price broke. So this would be the extreme demand. Okay, so extreme demand. And then now we would have this other demand. Okay, remember? Another very good example. So instead of just cover, even though that this candle broke on top of this, like you always need to cover the low as well. So like it would look like that. Okay, boom. So, and also what do you see? Because this came back here and pulled back up. I mean, the pullback, and then it broke the supply. So right now, after this move here,
we would now mark this as a failed supply because it couldn't hold price, correct? I'm just gonna mark it. Like you see also that how we use like historical data to analyze and keep our, like I'm just gonna be marking this because this all makes sense to mark. Remember supply, this was the price that pushed before this move here. We had a pullback and then we had the push. So right now I would be looking at this. I could also be looking at this buy to sell area you see there, but let's see how price will react first because I can always mark this later. Okay, so let's continue here because we're now on a swing bullish move, and after the breakout structure, which was here to the upside, we can expect maybe a pullback. So it depends like how deep the pullback will be. Let's see, boom, boom, boom. Okay, so like how deep the pullback will be will depend on how strong is the trend, because sometimes it can just come here and continue going up, you see. But like let's play it forward. I forgot to mark this guy. And again, right, the sell to buy area here on the daily will be something on the 4 hour, will be like a small push and a pullback. Then we had the push again. We would have the 4 hour there. Let's see. So this is like even more probability now that because price broke this supply, and this supply. If it only breaks like with a little pip above, like I would already see this as a failed supply. Both of these ones now, right? Okay, so right now, okay, so price like barely touched that one. Let me see. Sometimes you can just remember to use the old, I always forget the name of these guys, OHLC values. So like if you right click on this on this name here, it's gonna open these values, which you can see like the high of the candle, it's gonna be displayed here. And like let's see, the high of that candle is 0.222 and the low of this candle is 0.227. Oh, sorry about that. Let me use this, it's gonna be easier. 0.220. So yeah, it didn't really like mitigate it. It didn't got to there. Let's see on the lower time frame what happened. Yeah, so you can also see on the lower time frame that there was a buy to sell on there. You see. Boom. And it just like, I think it mitigated it. So that was the high, 0.22. I'm just looking at the price here. 0.2232 and 0.227. You see like it did mitigate it, this sell to buy area, instead of going to the nearest point here, which would be this inside bar. Okay, so like let's just keep playing because this is just to get you guys an idea like how price move. It doesn't need to come all the way here or here, especially because it just switched to a bullish state. And remember, like when we see, okay, this was our swing, now you can mark this as a swing as well. And now you can have that as our strong low. Boom. Okay, again, we had this. We can mark this as our new demand chain. So because price came here to mitigate this, and we had that. And again, right? So like we had a small mitigation here, but I would probably just like mark this low part Okay. So instead of the whole candle, because it already mitigated, but this is the same concept of the discount and premium, right? So like you don't want to buy like too high like this after a break. You want to wait until price um, comes to a discount area so you can buy at a better price. Okay, so now we are getting to this daily supply there. Let's see what happened. Price broke again. Okay, same thing, right? Now that we broke, so even though that like we had this push here, right? So even though that this candle, like this candle breaks above this, but you see that there was a pullback that mitigated all this area. So I would probably just use this candle here, because this was like the lowest point of the pullback that pushed price up. And it doesn't mean that price is like it can't just come all the way down here, right? So I would just leave this there, and we can continue looking at price action. So I'm gonna try to go a little faster. So, but I hope you guys are understanding the concept. You see, now that we had another mitigation of this this daily supply here. So you see, remember, like the concept, we use historical data to analyze what's going on right now in the present. Okay, so let's continue. Okay, let's go to the 4 hour. So it's kind of sideways. Yeah, you see, like this was in December. December was very choppy. Like this was like a recent, we are in February, so this was December, and I remember that it was kind of choppy that whole month. So we still have this whole daily demand here that we just marked, and we have this 4 hour demand right here. Let me mark this as the 4 hour demand. So you see, like I wouldn't do anything here because it's just like it's not doing anything. It's kind of stuck. Let me see what happens there. Yeah, we haven't had enough of a pullback to mark this as our swing high yet. So it's still, we had the push, pullback, and another push. So let's jump to the 4 hour and see what's going on. We have this demand here that hasn't been mitigated yet. Boom. So let's continue pushing. Yeah, you see there, price kind of, we try to break this high here of the recent daily that would be there. Let me see if we can see something. Yeah, so like we came here very choppy, right? So like price was just accumulating orders, and then we had our reaction to this 4 hour. Remember that even though this is a, like I would be marking all of this, but there's no need because it was kind of just sideways, and this would be the extreme. So like when price is like this, you stay out of the middle and you trade from the extremes, which like the highest probability to continue a high from here would be this extreme area here, and that we hadn't mitigated that area yet. Okay, so again we had this right now, right? So price broke below there, so we would have first this 4 hour. Remember that price is still inside of this daily, which is this one here. I'm just gonna drag this down, and it respected because it couldn't break this high here. So we still inside of that daily supply. Price came here, tried to break that high again, and it couldn't. and then we push back down. And another thing is that you can see that we had a mitigation there. Let me use the straight arrow. Like you see, we had a mitigation of this little guy, and then like price push from here, we had a mitigation here. Okay, so like where did price like came from? All the way up here. So that's why I marked this demand. Oops, why is it not working? Let's see. That's why I marked this as the demand. But as you can see now, price has broken the demand. So we could possibly see price pulling back here to maybe continue down, or maybe like, remember that this was our daily extreme, but I can mark this instead with a like a 4 hour to make it easier and cleaner on the chart. So this will be our 4 hour demand. Okay, so that was the daily there. Remember that this is still our daily strong, and we are on this move here. Boom. See like how here we had like a better push, and then on the daily we would see like this push. Okay. So we are trading between this low, which is strong low, and now that high, which was the weak high on the daily. Okay, but price still has respected the demand, the supply. So let's see what's gonna happen. Let's push a little. Like after a push like this, we wanna wait to see price come back into this supply, or maybe coming back to this demand here, since we're already broke down here. Okay, so let's keep pushing. Okay, we didn't go up all the way up there, but we still have that 4 hour here unmitigated, right? Because we didn't see any price action go back down here. Okay, so oh wait, I think I missed something. So I played it too fast. So let's see what happened here. Okay, so let's drop to the 15-minute, which is our it's the main time frame where we are looking like for high probability places to take trades. So right now we wouldn't be doing anything until now, right? Now that we touched the 4 hour demand. So let me just go back here. Okay. So guys, like remember, like we could have a chalk down here. Now we had a chalk. But like still, like look at the waves. Look at the waves of price. Like we still on this bullish move, right? So like now we didn't respect this demand zone, which is here, this one. So price came here. It's a little harder with the bar replay because you can't really see like in real time. But we had this 4 hour here, remember? So we had this 4 hour and this 4 hour, which was the daily as well. And now price is reacting to this. So if we think about the fractal, okay, the fractal of the market, remember like the fractal structure is just a little pause. So we had a pullback here, a break, and now we have a chalk on to the upside. So we had a daily chalk. Let me see, daily chalk here. Oh, sorry, 4 hour chalk. That's why. Sorry guys, 4 hour chalk. So now we had the 4 hour chalk to the upside. Of course, why it's not working? Let me try this again. 4 hour chalk dark. Okay. All right. Okay. So here, right? So we got to that 4-hour demand that was unmitigated. We had now a 4-hour bullish chalk. The swing is bullish, and we are rejecting this super. I mean, I wouldn't say super strong, but since it was like all the way down here of this move, and our like even like just by looking at now, I didn't see this before, but just by looking at this now, our swing 4-hour are also bullish. So let me see, boss, right? And then we still, okay, so we had this push, pull back, push again. All of this doesn't matter until like the swing is still bullish because price hasn't broke this low yet. So let me see if I have the, so we still have this as our strong 4-hour low, which will be that. Okay, so we are still inside of swing bullish. Okay, so swing bullish, daily bullish, even though we had a failure to close above this, but remember what I told you guys a couple minutes ago, that we can still like have a first reaction, come back, mitigate something, and still continue up. So right now that we had this 4-hour chalk, we could maybe go look for a trade on the 15. So let's see here. Let me since this is a little faster, let me also like play this on the 15 so we can see what's going on. Yeah, you see like our chalk on the 4-hour, which already happened, would be up there, like right there. Okay, because let me see, so we had, yeah, this swing. So I guess so we had this super like strong push here, and then we had the bearish boss, and now we had the reaction we saw on the 4-hour, and also we had this like bullish move, bullish chalk, which it's very hard to see because it was this one here. Like remember the fractal, we came here, boom, then we pushed down. So which one is the nearest point for a bullish chalk? It would be here. Okay, so we also had another bullish chalk. So I don't enter on the 15, but like later on maybe I can introduce you guys to take more like swing trades, but I would take maybe a 1 minute entry here. So let's see, I think the 1 minute would be better, but even if you wanted to put your stop here, yeah, too big of a stop. So I would probably be looking at the 1 minute, but let's just put it here just to see what's going on. If you maybe want to take the the swing path. Okay, so we could probably, let me look there. Yeah, you see it already happened. But like we would have this daily, I mean this 4-hour supply and that 4-hour supply. You see, remember guys, daily swing bullish, 4-hour swing bullish. This is our strong 4-hour, and then we had the 4-hour chalk bullish and the 15-minute chalk bullish. So you cannot get any better than that. So if you're taking trades, you could take like some partials, maybe inside, like you see, like there's a 15-minute here, which you can mark. You see like how it stacks up one on top of the other, and there's another one here. This is a very choppy, so just so you guys can have an idea. So if you wanted to be safer, you could take, even with this crazy stop here, we usually have like a 5-6 pips stop. This is 20. You would have a 4.3 to this zone. And like if you wanted to maybe take 50% of your trade here, and then like maybe push a little further to this other 4-hour supply, which this is a very probable area because price might just push up again, but it's safer for you guys at least to target these here. And let's see. So let's see. Let's just play on the. Yeah, this was a very. It typically don't move like this. So yeah, but again, guys, if you wanted to be safer, you could just like measure, get out here for this target, or if you wanted to push a little more, you could come to here. All right. Okay, guys, so I hope you guys get the point and the concept of the demand and supply. This was a little extended, but I'm trying to do like larger videos for the practice and not like 10 small videos because that makes it harder for you to understand. So I hope you guys have the patience to learn and to be like listening to these videos, because the whole concept is around this this method that I use. Okay, so remember, like practice like mapping your 15-minute zones inside of the 4-hour and the 4-hour zones inside of the daily zones. You see like daily here, and you can even like come here to like make sure that you have the right zone here. So like 4-hour daily, another 4-hour here, 4-hour. Okay. All right, guys. So again, if you have any question, just leave a comment on the video section, and I'll go over it with you guys in more detail if you need. Thank you so much.
So what's liquidity? Market liquidity is defined as how easy it is to buy or sell an item without causing a drastic change in price. Something that can be bought or sold quickly and somewhat easy and for fair prices would be considered liquid. So without liquidity, orders can't be matched between buyers and sellers, meaning there has to be a seller at a certain price for that order to be filled at that price. So as we talked earlier, large institutions need to fill their massive orders, so they are constantly seeking liquidity in the market. Liquidity is basically a pool of orders resting at a specific price level waiting to be filled. There are many Forex coaches that don't put much thought into liquidity. I just don't get it. Not understanding liquidity is the same as not knowing market structure, and it's the reason why retail traders lose so much money in Forex. My trading strategy is all based on liquidity, and I only became profitable on my trades after fully understanding the concept. So it doesn't matter if you're trading stocks, Forex, buying houses, or selling fidget spinners at the end of the hype. When everyone is doing something, it's a signal that the money is stepping in. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." Our concept is called smart money mostly because we understand liquidity. Simply put, if you can't spot liquidity on your charts, you're basically being used as liquidity to fill someone else's order. So after learning this concept, you realize why most break and retest pattern strategies don't work. As the market moves and structure are created, the price is also creating these pools of liquidity to be filled. So you'll be able to spot these liquidity areas by looking at swing structure, equals highs and lows, as price chains are formed, etc. So behind or above these forms of the structures, there will most likely be orders waiting to be filled. So if we think about it, these patterns are creating the market to lure people to place their stops at specific places and to fill those pools of liquidity. That's why when price gets to those levels, the big orders will be filled, creating the spikes in price. As we map our market structure and find our supply and demand zones, we also need to be spotting these liquidity areas. And there are two main ways in which we can do that: by using inducement or sweeps of liquidity. So inducement works as a magnet of price. As the market structure is formed, the price will leave these induced areas behind to then later come back to fill those orders. It even seems like it's telling you where to look to find these high probability zones. The sweep of liquidity is the act of taking the liquidity. So the price can sweep the liquidity of an induced zone or sweep the zone itself in order to grab liquidity. We can then use this swept area as a confluence when choosing our high probability zones to trade from. Together with the other tools we have learned in this class, inducement and sweep will also be one of the main confluences we use to take trades. We will go over this concept in more detail in our trading strategy section. Hello everyone again. So let's continue with our learning sections, and this is one of the most interesting and valuable parts of our trading strategy on smart money. So in this video we're gonna be looking at liquidity. So I'm gonna be teaching you guys everything about liquidity and how I see the market and how we here from our team we see liquidity and how to spot it and how we can map the charts to look for liquidity. And so let's start, right? So if you guys, just to make it simple for you guys, so because we can go on and on about how the large institutions, I think we went over that a lot on our course already. But as you remember before, I was always talking about how large institutions are the ones that move the market, and they are always looking for liquidity because they have these huge orders and they need a massive amount of orders to make the market move, correct? So like they need to fill these orders using liquidity in the market. So if you think about that, so liquidity simply means like orders resting, pools of orders resting in the market, you know, and that can fill the price of these orders. So the largest institutions can fill their orders, then they can buy, and since the forex market is so liquid, it has like so much money. There's like trillions of dollars traded every day. So they need to make the market move using like whatever is available, right? In terms of liquidity in the market. So let's just like I'm just going to give you guys some examples of how we can see liquidity, right? Okay, so when we are trying to spot these areas of liquidity, there are two main ways that we use to map it and to kind of like identify these areas. So like these two ways we called inducement, right? And then sweep of liquidity. Did I spell it right? Oh yeah, okay. I'm just gonna put this thing here so you guys can remember. Let me give a like space, or maybe like down here. Okay, so inducement and sweep liquidity. So let me just tell you guys how like sweep the inducement works first. So the inducement is like it's when price creates the structure, and it like as it continues moving and moving and moving, it creates the inducement. So it's inducing like people or the orders or the price to come down here, right? So it's like a magnet. It's like telling you like, look at this. You're like, you see all these arrows here, like look at this area, look what's going on here, you know. Sometimes like we're gonna see like price like making
like higher highs like this, coming here, making inducement, going back there, and coming here and going up. So like this area here was inducing this demand. So like so price could come here to then continue up. So let me. So yeah, that's how it works. Like so in the inducement, so one of the ways, like usually it's like I said, the one of the main ways you're gonna see like the inducement, it's when you see like price, like let's say, let me just draw this guy here again. I didn't do a good job with the drawing. Right, so we're gonna have like a demand here, right? So you would see like a candle, like a demand down here. So instead of price coming down here to mitigate this area, you would create inducement. Here I go again with this. You would create inducement to this area below. So when price breaks again, like some like people that don't look at inducement, they would be taking like longs from here because it's higher high, right? So they would take longs from here instead of looking at the inducement of this area below. Okay, so this is one of the examples we can look at. So right here, so like if I was trading and analyzing the market, so right away, because I'm looking at this demand chain, I would already place my like the mapping. That's what I use, the little money sign to show me that that there was inducement to this area. So I wouldn't be taking any trades here because there was no liquidity taken here, you see. So like I would expect price to come all the way down here first to then continue the price. Okay, so let's continue here, correct? So we saw like when when price came all the way down here to this demand that was induced, so we had this huge spike of price because here there was all the the orders resting, and it was all filled, making the price move. So like we came here, we had a push, we had a pullback, another push. So this would be like a fractal break, and then like this would be a chalk. So I want you guys to remember, I don't know if you guys remember, but when I said sometimes they're like what seems like a chalk, it can be a sweep of liquidity, right? So like because we're still on a bullish move, so even though the price came here, like we had a fractal break to the upside, and then so this would be after this break here, right? So this would be like a push, a pullback, and a push. So this would be the nearest low. So here would be the fractal bearish chalk. So instead, price, we would, because of the fractal break, we would have our demand here, correct? But because there was no inducement, remember, like I showed you guys, like there was no inducement to this area here. So like because there was no inducement to this area, like here, right? To price come to take the liquidity, it used the low of this move as to sweep the liquidity. So in this case, there was no inducement, and price, there was no sweep of liquidity. So the sweep of liquidity is the act of like sweeping the, like grabbing the liquidity, if I can say it better. So like right here, I use another line to this kind of move just to show that price will swap here.
So I would use this 4-hour sweep. Okay, so like just to show that price, there was a reason why price broke this demand, was just to get the orders below here to fill the orders to continue up. So are we gonna be looking at like risk entries and confirmations entries? So that's why, like when we are looking to enter shorts from a counter trend, because this is a bullish move, we want to wait for, like, let's say if this could have been a chalk too. So that's what I want you guys to understand too, right? So we could have price come here, and then we could have like had another push down to continue here and maybe continue up. So this could have been a chalk as well. So, but instead of just entering with a risk entry here, we would just like wait for a confirmation that this area is holding to then take the short like from there. But that's gonna be on the next lesson that we're gonna be learning about structure. Entries. Okay, guys. So first, right? Just going over this again, inducement is the like price is creating this pattern or anything like this pattern or any move to induce the price, the movement to come here to grab the orders again to then continue a move. If this was like a bearish move, the same thing. Okay, so now we had, because price came here, we had a bearish break of structure, and we still push up again, right? So because if this was a chalk, we would have this and a push down, but instead price came here, and instead of we respecting the supply that was created, with the fractal structure, which would be here, right? So when we had a chalk, we have a chalk. We would have a supply here, but we can see that price did not respect the supply area that was created, and then we had a break of this area. So now we can be certain that this was a sweep. So like if I just saw this happen on the first time, I could just like mark this as a chalk, and then so like, because I would wait for a confirmation here to see if this area would hold, but like I saw that this didn't hold. So if I see a break of these highs here just by a little pip, I would already like mark this as a sweep. Okay, all right, so let's continue. I'll just leave this here so you guys can look later or have as an example, so you can see that this would be like inducement to this area below. Okay, so again, right here, the same thing. So like if we think about people that trade patterns, right? Like this could be like a flag, right? A flag, maybe like this. So because like we had like this push, boom, second push, boom. So I say this because I have traded this way before, which like it was a nightmare. But now you can see, right? So if you traded or patterns or traded, if you still trade patterns and you're learning this new way, I don't want you to get offended by any means. I'm just showing based on my experience. Okay, so like this would be a flag, but with our strategy, we know that there's price resting here because of these equal highs, and there's price resting here because of these equal lows. Okay, so just like just to keep an eye on this, right? So like if you trade or used to trade pattern trading, you would be entering on the break of this flag here.
So, but because like many days of the pattern traders, they don't use supply and demand, they wouldn't know that when here on the break there was already there was the price was creating inducement, right, with these equal highs to come mitigate this extreme supply area here. So like you just got, so like this was just to lure people to be on the wrong side of the market. So they create these patterns to say like, oh look, there's resistance here. So like if there's a break, you can just enter, but you can see that like after you enter, like let's say you would have like a stop here, and maybe like you would have your stop below that, like that wouldn't even be like a 1-to-1. Look at that. Like maybe it would be like, oh, you would wait for, I don't know what your rules for breaking it even would be, but that would be already a loss. Okay, so look at that. Or maybe even like this. All right. So this is a good example. I'm gonna show you the example, like this exact pattern on another chart later on, or maybe I will just show this before I start this course. I mean this section. So I will decide later. But anyways, let's continue here. So now that we know that this is equal highs and equal lows, right? So we know that these equal highs here are just creating inducement to this area, to this supply. So we see that when price comes and mitigate this supply, you fill all the orders you needed, and then we had a chalk, right? So we had a chalk here, and so the same thing, right? I don't know. Some people might have a rule that if the flag fails here, right? So like if we fail to if we fail to go long here, right, we would have like an entry here, right, and we would go long. So like if it fails to go long here, no, now I'm gonna go short because that failed, right? So maybe I don't know, like you would, if you had another structure here, you could probably enter short with the, let's say with the stops below, I mean above some type of structure here on the lower time frame, you probably would get another loss because, oh, what happened, like because I got a loss here. I thought it would go up. I mean, I thought it would go up and then it went down. I thought it would end down and I got another loss. So but now that we know about the chalk and the like supply, liquidity, so we would see that, okay, now we had a real chalk here. Let me just mark this guy. So now we had a real chalk. Where is that? Boom. Okay, right? So first thing that price like wants to continue maybe down. We don't know yet. Okay. So we had the first chalk, right? We would wait because we had so this was the push, right? The pullback, the push again. But because this was because there was this internal, I mean the internal of the internal structure here. So this would be the nearest low of this push. So our chalk change of character would be right here. Okay, so now when we have a chalk or a break of a fractal to the bear side, then we would have a new supply area here, because like the reason there was a there was enough price here that made this push down. So probably there's like a level, a price level here where we can't be looking for shorts. Okay, so now like with our strategy, we would like look for a confirmation entry here, and we could probably even like just take like a short all the way to this demand for a 6-to-1 now. because we don't want to be like entering on the break or the break. We wait to buy on a premium price. I mean, sell on a premium price, because we want to wait. We don't want to, like, this price already happened, right? So we want to wait to come to a very good area of sales, so we can enter with like a small stop and then target the next structure. Correct? So I hope you guys are like seeing what I mean, right? Okay, so let's continue here. So now that, again, right? So let's say that, oh no, now this is going down because we rejected and people are thinking that it's going down. But we know, right? We are following structure, and we know that this area was already, let me just change this guy. So we know that this area was already swept. So like price already tried to break these lows, and we couldn't break, and we just had a sweep of liquidity of these lows here. Let me see if I can just put in. So let's see. I'll just put like a. Okay, I should make it just bigger. Sorry guys, I just always try to make this this looks like shit. Let me just delete. Okay, so like we know that price already swept this, and we don't. So we already tried to break this below. So like we have another like a higher probability, like place that if we might want to continue the move up, and because we already swept this area, so this could be an area that we could be looking for longs now to continue, right? You see, like the swing moves. Let me change the. So if we think about like the swing, right? Remember the first section that we studied, the swing moves of the market. Boom. Okay. To continue up. All right. So let me just delete this, so you guys already know this. You guys are already professionals, so you don't need this anymore. So now we took a short, right? All the way from the top there. We know about liquidity. We waited for price to come back to like a very good area for sales. Then, because we know that this was just a counter trend, and price is still bullish on the swing time frame, I mean the swing structure. So we know that price might just bounce here to continue up. So what are we gonna do? We're gonna, of course, this is gonna play, right? Let me just, so like knowing that, like what we're gonna do, we know that we can already like target these shorts here for a quick 6 hours, 6 to 1, very good. Like you don't see this every day with like just regular strategies. 6 to 1, like just on a counter trend, and then we can be looking for like a 1 minute, even like a just like a 1 minute entry. Remember I told you guys that we look at the 1 minute for entries. So we could be looking at the 1 minute time frame to look for entries here already, because we already know that this area was already swept, right? But like we don't want to be taking risk entries here. We're gonna learn this later. Sorry about mentioning this to you guys, but like it's just like the confirmation is just like we need to see that this area wants to hold. But because we had the sweep, there's already a very possibility that this might hold. So like we would take another, let's say like we would wait for confirmation here to then go up. Then we would take another, let's say I would even enter on the 15 minute. Okay, with the stops below here somewhere. And then we could even get out here of this, because we know this is a weak low, right? The weak low is strong low. I mean, sorry guys. This would be the strong low, and that's the weak high. So we know that it's most probable that price will just break through these highs. So we could even like get like 50% off of our trade, 80% off, right? Or like just get out for 8R here, or 8.5 or something like that, you know? Or just like get out for like 80% and let 20%, 30% like go for to the moon. So all right, guys. So this is the concept. This is super important. I think like this was one of the most important things that I learned with this strategy, and this helped me a lot to understand like market movement. Why am I always getting burned and always getting stopped out on these trades? Because because you gotta stack everything on top of the other. Because like how many times were you right about the direction of the market, right? How many times you were right that it was making higher highs and it was going up, but every time like you were getting stopped out before the move. So like you would try to enter on a break, and then you would get stopped out, and then price would go. You would try to enter a short here, then price would sweep you and then go again. And now that I remember another example here, right? So that's another thing. Like since price, just going back to this example because I remember another thing that I wanted to mention. So like since price already mitigated this demand that had the sweep, you don't want to be looking for shorts again from this, right? Right, because remember, so after we had this first fractal break, we would get a supply here, okay? So again, when we had another break of this low, so now we would have another supply area here, correct? But because this is creating a supply chain, like this came here, like it mitigated a supply somewhere inside here. It broke down, it came here, mitigated this, and now we would have another supply area here. But again, guys, like we know that price already did this move, like it already completed the move. So we don't want to take another short from here, right? So we don't want to be taking another short. Let me delete this guy because it's kind of pissing me off. So you don't want to be taking another short from here, because we know that the overall structure is bullish, unless we would get a break. Let me delete this. Unless, because like we already saw, we had a sweep of this zone. So like the job of this price action here was already completed. Okay, so if price comes here and then break this demand, we could possibly look for another. Let me see how I can do this now. So we could already kind of see like something like that, because like this area was already swept. So why did price break this area? You know? So like now this is gone. So like it had sweep, the demand didn't hold. So probably price wants just to like make a deeper pullback and maybe come here and then continue up, or maybe just die out from here. So, but we know that because price failed here, this demand failed to hold price, then we could continue with the supply chain and it's like look for another entry here, and then we can take the
the shorts again. All right. So let me just show you guys some examples on the real charts that I have open here before we finish this section. Let me see. This is like today. So like this is happening. I was just looking at some of the areas I marked here later on the week and on the month. So like I usually like delete like old mapping because it kind of slows down the chart depending on how much zones you have. But we can like look here super quick on this price action. So here we were on the bullish swing move. So everything inside here was just internal structure, as you can see with the orange dots. Okay, so here, right, we tried to break the high, we couldn't. Then price came here, so it was supposed to continue this internal move. It was supposed to respect like some of the demands that we had here. Sorry guys, I already deleted some of these. Let me see if I can grab like just a demand area here. So probably like something like this. Let me see. I'm just looking at this now, so hopefully I'm not gonna make any mistake. But you see here, right? So we already like tried it once to break that, came down here. Now we had the break with the body closure on top here. So we had this strong low, weak high, strong low. This was supposed to be the weak high, but then this was the first sign. You can see there that we had induced. Where's the line? So we had inducement to this area below here. Where is this? So we had inducement to this area below here. So price just came here, mitigated, reacted, came here. There was volatility. There was probably something like news or something. That price came all the way up there. And then, but we had already, remember what I just told you guys about the break, right? Like it already broke. So the job of this inducement was for price to come here to mitigate this demand, right? Because we had inducement here. So since this demand couldn't hold and there was a breakdown here, so we went all the way up there and we continued down. You see, like that's why we could. You see, like some like the example that I just showed you here. So price broke here, came all the way up there to mitigate this supply chain, and then continue down. So we could be looking for entries on this 15-minute here. All right. So just one example. This is a little choppy because like overall you can see it's kind of sideways, but we have a lot of room to trade inside of here. Just knowing that we are on the bullish move again. So now like we saw inducement, but price just broke through. Why? Because there was like a failure to break on top of there. Okay. So like when you see a failure to break like a major point like in the market, you could already expect that probably it wants to pull back a little more like before continue up. So it didn't respect this demand, so we had the mitigation of the supply, and then we had the internal structure turn bearish. We had a like push, pull back. The internal kind of turn bearish here somewhere. Then we waited for a pullback again. Guys, this will be, it's like a ultra. I'm just giving some examples, but there's nothing better than practice. Like I can't spend hours and hours here in one day. You guys gonna burn out, but this will be with the daily analysis we're gonna be doing every single day. This is like, as a trader, this is something you do every single day of your trading life. So don't worry, you're gonna have enough practice. Like in the beginning, I didn't know about this either, but as more that you do your analysis, the better you're gonna become. Okay, so like another example here. Remember this was inducement to this area. So like before, you can see that this. Let me try to hide this. You can see that here we had so like we came here, we had a pullback, we had a push, price came, reacted to here to this demand, and then we had a chalk here, boom, chalk. So when we had a chalk, we had this little pullback here. You can see. Remember what is the internal, how do you say, the inside bar means? It just means that like even like on the lower time frame, it's making like a pullback. So like we had like a small chalk here, price pushed, pullback, but you can see that the pullback did not mitigate this extreme candle, right? So like you can see that it got really close. If it like there's a rule I have for me. If it's the same pip, if price here, right? Let's say it's 100, just to give like an example. If this like pulls back to 100 and this low of this candle was 100, this is not a mitigation for me. So like this pullback here would have to at least go to 101 and then push down. So that would be a mitigation. If it's 100 on this lower number here and 100 on this higher number here, this is not a mitigation. And this one didn't even like got to there. It would probably be like a 95. I'm just giving like a random example to make it easy. But okay, let me put on the charts again. So here, let me just turn off for a second. So here, like I would see this, there's inducement. This high here is creating inducement to this candle, to this area, saying like, hey, look at here, like I didn't touch that guy. So price will probably come back to touch there before we go down. Okay, so like the inducement, it's literally like a arrow, like look at that place because I might go there again. So what happened? We had inducement here. So once we had we had the sweep of the liquidity, now we swept the inducement of this zone. So we have a swept area. Okay? So now we have this new supply. Price came here again, but because you see like we had already mitigated here, there was no inducement to this area. So instead, okay, so like you're gonna see this everywhere, but like you see like price was here, it came to mitigate this area, broke down again, but because there was no inducement, I don't know what's going on with my charts. Okay, but because there was no inducement, remember the chain that I showed you guys? Look at this. So like in this example, right? So price could just have swept this zone here instead of going down there. So it could just have done like here, coming back, and then pushed up. So this would also be a sweep of the zone, like it happened here, right? So it came here, mitigated that, came here, mitigated that. So instead, there was no inducement or sweep. So it came to sweep these highs, and then it pushed down again. But now, like you would have to do the whole analysis, but like I'm just showing you some examples of what happened. Here we can see another one, like inducement, but another thing, right, guys? So like price doesn't, every time that there's inducement, it doesn't need to come here and like beautifully like move like and give us an entry and go down. No, price may just leave this inducement here for later on, maybe in a month or a week, come back and retest that. But we already got to where we wanted to be. So you already completed the move. So like this, like we don't need to pay attention to this anymore because this already happened. But later on, you can see that this induced area, you see that there was a reaction there. So like let's go there now. So we can see here, right? We had a push, a pullback. Another example. Remember here, guys, I was telling you, push, pullback, push. Instead of being a chalk, it was just a sweep. Okay, same here. The chalk can be just to mitigate. It would just to facilitate the internal, just to the fractal, just to facilitate price to come down here to mitigate this. This was the job of that move, was to come here down here to continue up. So same happened here. You see? Let me make this bigger. So we had the push, the pullback came here. So we would mark this as the chalk first, but we saw that there was this unmitigated zone, demand here, right? And like look at where it went. There was like this candle here, like it made inducement to the zone below. So price just gave the chalk to mitigate this demand to push up again. And look what happened. Remember the example? Because this was already swept. So now this is a higher probability. So now this is a high probability area that it would go up. So look at here. And this I'm just like, I didn't even look at this before. Like this I'm gonna, I was just looking before you starting the practice and I saw the chart. So I wanted to go over this. But you can clearly see here, right? Because this was already swept, this area. So when price broke structure again to the upside, it just can, I remember this was like on last week sometime, and there was this huge news. I think this was NFP, I believe. I'm not sure. But even on like volatility news, look at where price came. It broke, closed above, and where it came here, it respected this swept zone, and it just went all the way up. Think about, you don't want to enter trades like this, but think about a trade like that. You enter on a swept zone like this, you would refine this demand probably even on the 15. I'm not even looking at the one. Like put your stops below here, and then like price would crazy. You see that like the next target would be this demand, this daily supply from 10-1. But this was new, so I wouldn't trade this anyways because I want to get the slippage. Another sweep. You see, push, pull back. This was supposed to be a chalk, but like price just continued below, so this was a sweep. Very good area to look for shorts, but because price already mitigated a very high probability place to maybe it wants to pull back from this place. I'm not gonna be looking at this right now, but maybe we would have like a pullback to this area here, but because
this area like has inducement. There was a sweep. We could look for shorts from there again. And it continues over and over and over, even here, right? Like I see this so much, like every single day, that I sometimes I don't even mark anything. This was today or yesterday, Monday. Like today is Tuesday. That was yesterday. Like sometimes I don't even mark it, but because there was inducement there. This class is more extended than I intended. Sorry, you guys, but this is very good for you guys to understand. Okay, remember, you don't want to be like chasing. You see, like price came here, pulled back. You don't want to be chasing price down here, since there is inducement to that area above here. You don't want to take like even on our strategy. Oh, I'm gonna take a continuation, but like, okay, but price is already so extended, so you want to be taking continuations down here, knowing that there is like a lot of inducement and liquidity on top here, and price may just come to mitigate this area like it did. You see? So like it came here like beautifully, but I think this was during London time and I didn't take any trade here, but there was a trade here somewhere. So price just came to this induced zone, and then you could take another short from here. I don't know where. Yeah, but because like when it mitigated that zone, it came and it mitigated another demand. So it would probably not be, because this could just be like doing this to go up. But like since we had price push here, yeah, I'm not sure right now. I would have to go to the lower time frame. Maybe the 1 minute would be clear. But just to show you guys the how powerful this strategy is and how powerful it is to stack market structure, supply and demand, and liquidity together. Like it's a killer like knowledge for your trades, and you would be ahead of like most of traders already just by looking at this, because you would always be like watching your back in some way, right? Okay, guys, so enough with the examples and the teaching about this. And like I said, don't worry, because we're gonna be going over this liquidity and everything every single day of your life. So have a good one, guys, and I'll see you on the next video.
So finally, this is the final step in your technical analysis. This is the time you'll be entering trades if everything fits your plan. After you did all the work with your multi-time frame analysis, you have spotted liquidity by looking for inducement or sweep, and you have chosen a high probability 15-minute POI, we can then start looking for types of entries. In our trading club, we use 3 types of entry. This is the type of entry you take when you have everything else already confirmed. The limit order is placed at a 1 minute zone nested inside a 15-minute POI. So here are the positives and negatives for this type of entry. The first positive is that many times pairs like Aussie dollar, for example, may not give you a confirmation entry. So entering with a risk entry will help you be in that trade. The second positive is that if it's used correctly, it can be a more hands-off approach, as you don't need to wait for extra confirmation. It can also be high risk reward if the lower time frame zone is picked correctly. And now the negatives is that this is a more aggressive approach, as you need more experience to make sure that the POI will be respected. It's also more advanced style because you need to identify the right 1 minute POI for an entry. When you set your 15-minute POIs, you use this entry as further confirmation that the zone will be respected. What you want to see is a rejection of that POI, confirming that it's being respected. You would pretty much be looking for a 1-minute mitigation, a chalk, and a boss. And here are the positives. It can give you an extra confirmation for entry. It can also be a high risk reward by entering with a small stop loss. And the negatives, price may not give you a confirmation entry and you will miss moves. You need more patience as you need to wait for price development. So I have a different approach to double confirmation entries than other smart money concept teachers I've seen online. A double confirmation entry is self-explanatory. It means waiting for a second confirmation entry to enter a trade. My problem with this type of entry is that many times price have already moved so much and reacted to resistance. So you may be trying to enter after the price had already failed to break through that resistance. So instead, I use this method to scale in on my first position after the price has confirmed that it wants to continue moving toward my target. You'll see some examples of this on the trading strategy section. As you get more experience with your trades and you start to see the same patterns happen over and over on a pair that you follow, you'll be able to refine your entry zones. After choosing your 15-minute POI, you'll see that sometimes the 1-minute zone is not as easy to spot. So you may have to work on your analysis and experience to both protect your stop loss and at the same time, try to get triggered on the trade you're trying to enter. What I do for my trades is find the 1-minute zone and use the Gantt box, I believe that's the name, and highlight my area of interest. You then have the choice of entering at the distal, like the edge of the zone, the EQ, which is the equilibrium or the 50% of the zone, or you can use a more custom approach. So you'll be protecting your loss and you move your entry until it reaches the max pip allowance for that pair. And before you choose any of these three options, the number one priority is to protect your stop loss. You don't want to be tagged out of a trade just because you were too aggressive with your stop loss. I personally use option 3 as it allows me to enter more trades, but also to not chase trades trying to widen my stop. Also, just FYI, my minimum pip stop loss is 2 pips. Sometimes I plan my entry based on a strong target I'm aiming for. So since my RR is a 5-to-1, sometimes I will move my entry price to aim for that strong target. You might get tagged in on a trade or you might not. So you need to be okay with it and move on to the next trade. What you cannot do is base your trading plan around your emotions. Any decisions you make needs to be 100% mechanical. I think that being able to enter trades with 3 to 6 pips is already mind-blowing. Hitting 8 to 10 hours in minutes is super usual with this strategy. Just keep in mind that this specific lesson is to show you the overall foundation of our entries. We will use this initial idea and refine it even more in our trading strategy section. Hello everyone again to another video here, and this is gonna be such a cool session. I think you guys are gonna like this a lot because now we're gonna be starting to talk about entries, right? So I think all of you guys have been super excited to this moment because all of the concepts before is kind of like, oh, it takes a lot of time and I want to get into the trades. But yeah, here's the time. We're gonna be learning the how to enter trades and how to exit and stuff like that. So are you ready? You have your coffee? Okay, so let's start, right? So I'm gonna be using the same, like the chart that I drew for the liquidity concept, because this is a very good example what you might be, you're gonna be seeing on the chart. So like on your daily today, you're gonna be seeing the liquidity, the sweeps, and equal highs and lows, and like all this type of price action. So I think it's a good
very good example. And I hope you guys understood so about the liquidity concept, and I hope you guys went through that at least like 2 times, so you guys can get an idea of how everything works. And the more we start to advancing on our course, you see that every single thing aligns and builds on top of the other, like structure, the liquidity concepts, the multi-time frame analysis, the chalk, fractal and internal and swing. So you see, like, you're gonna need all of the concepts that we have studied. So if like there's no way you could be like taking shortcuts. That's why in the beginning of the intro for the course, I would say, like, if you're the type of person that likes to take shortcuts, this might not be for you, because I'm already concising everything that I learned throughout the years for you guys to understand in a simpler way. So make sure that you have the discipline to go over this as much as you can. So let's jump in to the first example. So I hope you guys remember, like, about the liquidity that we were talking about, and give me props for the drawing, because this took some time to do, and it looks awesome. So all right. Okay, guys, so we were talking on the last section about liquidity that, like, as price was making higher highs here, and then this was a flip because this was a reaction to this supply area, and here, right here, we broke that zone, correct? So like after we got this break here, just by 1 pip, like, this zone is already gone. Okay, so what happened? So after all of this was making higher highs, like, it was creating liquidity to be taken, like, underneath here. So like all these orders and all these orders and money was like resting down here, correct? So now that we know, like we're not gonna be jumping in like on the break here, or like too early in the, like, let's say, like, oh, we want to take a pullback and you want to like take longs here. That's too early, right? Remember the concept: push, pull back, push, pull back. Okay, so like remember, like, you don't want to be try to long it when price already went all this, like it already moves this much, correct? So like now that we know that we have the confluence, because we had the reaction, the flip, because it's reacting to the zone, and then it broke to the upside, and plus it was creating liquidity because it was just like mitigating here, mitigating here, mitigating here, and then it broke. So it was like it left all this zone here below. Okay, so let's jump here. Like, this is a zoomed in concept. I mean, kind of like a zooming area that you can see, which is what is happening here, correct? Okay, so as price right here, right, as we were moving like here up, and then we were on the 1 minute, like, this is I want to showcase the 1 minute time frame inside of this box, which would be like part of this move here, correct? So as price was moving, making higher highs on the 1 minute, it left these demand zones. Okay, remember also, like, when we were talking about the demand and supply zones, that we need to stack each time frame, the multi-time frame supply and demand creation. Okay, so inside of the 4 hour, we're gonna have the 15 minute. Inside the 15 minute, we will be looking for the 1 minute, in this case, demand zones, because like after when price was making higher highs inside the zone, it left all these unmitigated zones here. Okay, all right, so like, yeah, so it made higher highs inside here, and then it pushed, making like the high here,
right? That was the first push. Maybe you were already on the long down here going up, targeting this area, right? But we did have this area here that with the 1 minute higher highs. Okay, so let's talk about this now. So now that we had the flip, the break, and the inducement, this is an overall price is bullish, right? Like higher highs, higher highs. Overall, the price is bullish. So this is a very good area for you to take longs from. Okay, like of course you need to be doing the multi-time frame analysis and make sure that to know where price is on the higher time frame. But let's say that we already checked on the higher time frame, and now on the 15-minute, we know that like price is making higher highs, and this is a very good area because it has inducement. You already mitigated here, and it could price was creating liquidity, and now this is a very good area, which would be right here. Okay, so now we're gonna talk about like the risk entry and the confirmation entry. Okay, so the risk entry is pretty much like when you already have all the confirmation you need, everything is aligned, and the zone you want to enter from is kind of like the last point inside of a zone where price should hold if it wants to continue going towards your direction. Okay, it's a little more advanced because you need to be very sure about the area so you can be entering. So yeah, but it can be a very good type of entry because sometimes price can just tap here and go. So let me show you an example, right? So like I said before, we had inducement, break, okay, and we have this induced area here. So price, when it broke this structure down here, we knew that it only wanted, I mean, we have a lot of good confluences that this area should hold. And this would be only a sweep of these areas to continue our move higher, correct? So as we're going, as price is coming back down here, so as we were having the higher highs inside of this zone, so there's two ways we can go about this. Now that we are having like a lot of good confluences, we have the inducement and everything, this could be the last area that price might hold so we can continue the move up, okay? So if you don't want to, if you already have a lot of good positive confluences and you did all your analysis and you know that this is the last part, if price wants to continue going higher, this is the last zone, like, because if it breaks this, it would switch the direction. Like, let's say this is a swing, right? This would be switching the swing 15-minute to the like a bearish, okay? But so like for to enter on a risk entry, you would pretty much like, let's say, like set your order in one of these two guys here. Let's just look at this a little bit. Remember when I also told you guys that on the 1 minute and the 15-minute, all the time frames, we're gonna be looking for the same things. You see, like there's inducement here for this area, and on the 1 minute, like very little small time frame, we're also gonna be looking for the same things, correct? But because like we have this area here that before it didn't mitigate it here all the way down here, and it created this inducement for this area, okay? But let's say these move a little higher, okay? So like, but because like this price is kind of like far away from here, like, and we are not very sure about that this is an inducement because price already moved a lot, Okay, so all right, but we see that this is like inside of this 15-minute zone. This is the last. Remember that this is the here, right? At this area here, this is the last low, which would be like inside here. Okay, so this the 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 zone inside here, this is the last low. If it breaks this low, it would probably start going down from here. Okay, so like because this 1 minute already moved kind of high here, so we're not really sure if this is inducement to this area, to this demand. So but what else do we have here? So we have another inducement because this low didn't mitigate inside of this zone. So let me just delete this. So it's a higher probability that this is the actually the inducement for this zone below here. So on the 1 minute time frame, we're gonna be sweeping this area, sweeping this to come mitigate it down here, correct? So there are two. If you want to take a risk entry, like I said, it's just the risk entry. You're pretty much just setting your entry, your limit entry, in one of these two areas here, targeting, like we were gonna be talking about targeting later. Let me try to change this to make this a little more visible. Maybe like this. Yeah, just for now. Okay. So we're pretty much like we're setting our interest in one of these two. So if we think about it, okay, if you want to be, if you're really sure about this area, and if you want to be sure to get triggered when price comes down here, you could probably cover this. I don't like this color. Sorry, guys. Let me change this before we continue. What did I do? Of course, I'm gonna do that, right? Let me just leave like this. So if you're sure about this, and if you wanted to make sure that you're triggered on this move here, you could probably like set your entry on the first demand, and also make sure to cover the second demand here, correct? So you want to be sure that you want to enter like when price comes back like here, right? Going down here. So if you want to make sure that you get triggered, you could like maybe set your entry there and price would move up from here. Okay. But like if you want to be okay, like the pip stop is too large for, yeah, so I changed the color here. But so if you're unsure and the stop loss is too large to cover these two areas, you could also just set your entry down here, because we have the confluence that there is a inducement to this one below, and this is the last 1 minute demand also. Okay, so you could probably like set your entry down here instead. Okay, like this. And then when price comes down here to mitigate it, this area here, and maybe like give a little flip, and then it would come down here again and probably going up. Let me fix this. So like you could probably just set your entry up there, or you could cover the two areas, but always make sure that your stop is well protected below the last low. You don't want to be entering and putting your stop loss like here, for example, or like not covering that low because you're like, oh, I think this is gonna go. I think it's gonna go my way, right? It's always like always not better. You have to always cover that low, because you don't want to just be stopped out because you didn't do your job. Okay, your job as a trader is to manage your capital. Okay, it's not just to be entering trades. Okay, so this would be the risk entry. So like you're just gonna be setting your entry limit entry either on here covering the two on the or on the second one targeting up, right? And of course, like, because if you choose to just have your stop loss a little smaller on this lower one, you're gonna have more profit, because just by changing like from 6 pips to 2 pips for your stop loss, it makes a huge difference. But like if you decide to have like a smaller stop loss on this one, you're probably sometimes you're not gonna get triggered, and the guy that put his stop loss like a little bigger like that, he would probably get triggered a lot more than you. And you would miss a lot of trades because you're trying to be a little more greedy with your profits, and he's safer. But some other times you would get like double his profit because you enter with a smaller stop loss. Okay, so that's risk entry. Like I said, you pretty much know that this is the last zone, this is the last demand here that price should hold if it wants to continue going up. And you're super, and you have a lot of like positive confluences that price should hold there. I'm sorry. So now let's talk about the confirmation entry. Okay, again, right? We had the move here, and we had the inducement to this area. So if we want to be more sure about this area here, we would we would wait for a confirmation. Okay, so our confirmation entry pretty much means that you want to wait and see if inside this zone some of these 1 minute zones will hold price, like, because remember, like, we have the chalk and the higher highs and break of structure, and when price is coming back down here, it's making lower lows and lower highs, correct? So if it breaks this low here, it will pretty much be coming here and break the low. Okay, so you don't want that. You want to wait to see if price will change the direction to the upside after the lower lows and lower highs. So you pretty much want to see, okay, price came here, and then it mitigate the 1 minute. Maybe it made a flip here, and it broke to the upside, came here. Oh, now it starts to make higher highs again. Okay, so let's just jump into this example here again. So let me grab one of these guys here. So here, right? I'll just use so we had the mitigation of the 1 minute demand here, and then price pushed up. It mitigated, if it reacted to the supply zone, right? And then it reacted here, making this little push down. It created another inducement to that zone down there. Make this smaller. I'm just gonna delete this because it's gonna be too large. So it flipped, and it created this inducement zone to the extremes here. So it pretty much left this demand entry zone for you to take your longs from here. Okay. So I hope you guys understand what I'm doing. Remember, right? As price is coming down here, it's making lower lows. And here we had a reaction, which was a flip and a break. So this would be a chalk. So this right here on top of this one, this is the nearest point after the reaction. So we had a change of character here. So when price breaks this green little box by 1 pip, that's already your chalk, correct? So now you have another confluence that price is holding here, because we know that price may want to continue going up. We have a mitigation of this demand, a flip, a chalk, and now you can just take your entry from here. So you could enter on the edge of this zone. You could enter on the 15-minute, the 50%, or on the extreme. Let me try to move this guy here. So like this is I think I said something about this type of entries here. It's pretty much when you drag this on, this is how is this called, the GAN box. As you can see here, let me open the. So this is what I use, the 0, 0.5, and 1. So this is just mean that this is the 50%, and that's the 0 and the 1. Okay, so if you guys want to grab the settings, it's pretty much just like how you want to enter your trades. Let's say you don't really need that, but it's just good to see if you can get a better price, or if you don't want to be. It's pretty much like if you want a more profit, you would like enter down here, because this would be the extreme of the supply candle, or you want to take the longs from the 50% of the candle, or like enter on the edge, which like most of the times will get you like triggered more often, because sometimes like if you want to enter like down here, price would come here, maybe mitigate it just the edge and go without you, and because you wanted to squeeze more profit, making the stop loss a little smaller, you weren't triggered on this trade. Okay, so that's the downside about trying to change this. So what I do is, because I have a max pip for the stop loss at 6 pips. So my max pips for the stop loss is 6 pips. So sometimes if the candle is too big, I will draw my, let's say I have a candle right here, right? So I have a candle here, right? So I draw my zone, correct? But like this, like let's say that if I enter here, the stop loss would be 8 pips, right? But because I have a max stop loss of 6 pips, I would just like adjust my price until it's max at 6, and then I would move this to make sure that I cover the lows and I have enough space to get the longs. Okay, so and the same thing you can do is let's say we have another let's say we have another supply here, correct? And you're trying to take longs. So sometimes, like because I have a minimum of 5-to-1 like target risk reward, I want to take at least 5 Rs for every trade I take. And like let's say that like to get here, like the 6 pips, I would only get 3 Rs to that next supply. So what I do, I'll just adjust my stop loss to make sure that I'll get 5 Rs at the next target area. Like I hope you guys understand what I mean. Let me draw something here. I think this is gonna make it easier, right? So like I'm taking my longs here. So I want to make sure that when price, oh fuck, I want to make sure that when price comes to trigger me, that I would get at least 5 Rs at this next supply, which would be my target. If I enter here with a, like, let's say a 6 pip stop loss, and that only gives me like two Rs, two rewards to my risk, or 3 Rs, I'm not gonna be taking this. I prefer to draw to enter a little lower and make sure that I get a 5R when I target that. Okay, so I hope you guys understand that. Let me just, because we have a lot to cover still. I hope this video is not too long. I'm gonna try to get a little faster. So I hope you guys understand, correct? So the confirmation entry, you wanna wait for a mitigation, maybe a flip or just a chalk. We're gonna be talking about the strategy later, like things that you need to be watching for. But you're waiting for a mitigation of the 1 minute zone. Maybe it's even better if you get a flip, and then you had a chalk because it broke the fractal high there, and then you could enter here. All right. So, and then it went up. You see that it's kind of similar to this, right? We had inducement to here. We had inducement that created here. We had a break, a flip, a break, and an entry. And the same, right? Mitigation here, a flip, a break, and the inducement created for this zone below to go up. So sometimes if you are a swing trader and you wanted to enter on the 15-minute, you could enter here. So you don't want to wait, but your stop loss would be probably like a bigger. Maybe you have like a 10 pip max stop loss, so you could enter on the 50% of this zone, and you would target the high there, right? So, but this is for another session. Okay, guys, so I hope you guys get this idea here. So let's continue so you guys can get more examples. I'll just now just erase these guys here. Okay, right? So now we have the example 2. Okay, so now we took the longs. Maybe I'll just put an entry here. We took the longs inside here on the 1 minute, and we targeted. Maybe we took like 80%. We also gonna be talking about like how to manage your trades later, but maybe you took like 80% of your size here on these highs because you're not sure if this would break, and then you held another like 20% all the way up here. Okay, so that was our longs. Super cool, right? Like maybe this took like 2-3 days or maybe 2 days to happen, and then you enter here. Okay, boom. So now we had a mitigation, first reaction to that supply. Then it came here, it made like a fractal break to the upside, okay? And right here, so we're looking at inside of this 15-minute zone with a 1 minute supply inside of the 15-minute zone, correct? All right, so as price pushes higher here again, it's going higher, higher, higher. So this is what you're gonna be seeing on the 1 minute. All right. So like you see this first. Sorry, let me see here. Yeah, so you see this first reaction here, and then price comes back here, and then so let me just stop here for a second. So here, correct? The 1 minute is going here, and it reacted to this 15-minute zone, and it's not
inside of the 1 minute yet that you have drawn on. I personally, that's one thing that I do. I only take trades that also respects the 1 minute. As of today, like that's what I suggest you to do, because yeah, it's not worth it to be just taking the 1 minute chalks anywhere or 1 minute reversals anywhere. So that's one of the another confluences that I use for the trades. So let's continue here, right? So as price comes here, correct, and like on the 1 minute, you would see the first reaction here. Here, right? Like you would have your first chalk. Let me drag this guy here. So this was your first fractal, right? So when price mitigated and broke this nearest low here, we had the first chalk. So you see, like the confluence that we use, like we still on this bullish here, correct? We didn't mitigate the 1 minute, so we don't know yet if price will continue to going up. So like when you first have your chalk down here, right? Price might just be coming to mitigate like this supply, this demand down here. Look at that. So if you try to take like your shorts from there, because you already mitigated this area, so I want to be early on the shorts, right? Because price might react to this coming back down here, so I'm gonna be early on this, and you go and take your shorts here, right? Because you saw that price gave your bearish chalk here, but you weren't watching that it only gave the chalk to mitigate this demand down here. So you would be trying to take your shorts from here like this. Let me see. So you would cover here, and you would try to take your shorts, and you would probably get burned. You would get burned because you would break your supply and just continue going up. Okay, so that's one thing you don't want to do. Like, you got to make sure that every time price is reversing to give your entry, that it's not just reversing to react to come mitigate demand in this example here, right? Because we are reacting here, going up, going down. So you don't want to be taking the shorts here after it mitigates down here something on the a demand that was unmitigated down here. Okay, so that's like, keep making notes of these little things, because these are the stuff that's gonna save you guys a lot of losses. Okay, so let's continue here. We are not, since we already know, even though we had the chalk on the 1 minute here, we're not going to be taking shorts from here, because we know already that we haven't mitigated the 1 minute supply yet. We don't know if this is going to hold. Okay, so now, right? Okay, so price comes all the way up here, boom, and it breaks our last supply zone on the 1 minute. So now that it already broke the 1 minute supply, that's another confluence that price may still wants to continue going up from here. So we already know that it didn't hold this supply area didn't. This is the first signal that it's not holding. Like it could still, like I said before, price can, like the market can do whatever it wants. So we are just gathering confluences for us to enter a trade, correct? So this is the first signal that, like, this supply here, it's not holding, correct? So okay, so we're not taking any trades here, and because even, like, let's say now that
you saw here, right? You saw that this broke. It could possibly give you another like entry down here. That's where people get so burned, because they think that they can just continue taking the like entries anywhere, and they don't have any confluences for their entry. And possibly on this this time here, you could have a good, you know, and this, I don't think I already said this, but this is the worst thing that can happen to you. It's for you to have a lucky win. You would enter here, right? You don't have any confluences because price already broke your supply and everything, and you want to enter here again because, right? Because you had your chalk. So you had your chalk here to the downside, correct? Because you made a fractal high, pullback, break, and a chalk. So you enter here, and probably on this time here, you were lucky enough, and then you had a win, correct? But like, this is the worst thing that can happen to a new trader, is to have a lucky win, because then now every time you don't have your confluence and you want to take a trade like this just because it happened once and you think it's going to happen every time, but it's not, correct? So yeah, so we're not taking this. So I'm just going to delete this because we already know everything. And now we're not taking shorts from here because there's nothing holding price. So this is already gone. We're not taking any shorts because price, the overall order flow is bullish, correct? So this is gone. Okay, let's go to the next example, which is number 3. Hope you guys are still with me. This is a very good practice, and I hope you guys are learning something from this. Let me just delete this last one here. Okay. So continue with the order flow. Now, so as price pushed on the 15-minute pullback and pushed again, so you can see that on this leg here, on this push, there was no liquidity, there was no inducement or sweep zones. So if there was no sweep or liquidity here, we could probably be sweeping the low of this one. And right, remember what I said? Because on the liquidity concept, we think that like, oh, now we're gonna have a chalk and we want to take shorts from here, right? Because we had the change of direction, but it doesn't mean that every time that we have a change of character that we're gonna be going down from here. So it does, because overall is bullish. So at this time we could probably be sweeping liquidity. So how would it look on the 1 minute here? So here, right, on this leg going up, we probably, like, we had 1 minute come here, make a higher high, it swept this 1 minute demand zone and push high again, made a lower high, and it pushed up again. Okay, that's gone. That's right here. Okay, we're looking at this area, which was here. As price came back down here, we could probably be looking, because on the 15-minute we know that there's no inducement or liquidity taken here yet. So when price is going down here, we could expect that this 15-minute zone wouldn't hold, because we know that price is bullish and then there's no inducement or liquidity being taken here. So as price start coming down, so we probably know that this zone here is not gonna hold. And what price do is it comes back to this extreme 1 minute demand here, which would be below this low here.
So yeah, price would just come to mitigate this demand that wasn't mitigated before, and we would make another, right? So I'm gonna use another example now, and price comes here and push up. So guys, I'm using these examples just now. I didn't I didn't plan on it, but I've seen like for many years how price moves. So just bear with me here. Okay, so right here, right? Let me just move this a little to the side. So you're ready? So price broke this 1 minute demand and it broke this 15-minute demand. And what it did, it came to mitigate it, this 1 minute demand that was resting below here, below this low, correct? So it came here, the same thing. Price came, mitigated this, and right away it pushed up again, and it flipped this zone. It reacted to this supply, this 1 minute supply, and it reacted and it pulled back and it broke the supply. So it broke this this supply here, and again, right? Let me draw another. Let me make this a little more visible for you guys to see. So it reacted to this supply, and then there was another supply here, correct? And what price did, it broke that supply too. So it came here, it didn't, and like when it came down here, it left inducement to this extreme, and then price pushed up again, and it would be like, oh shit, I missed this trade, I didn't get triggered, price will just go without me. But it was just reacting to this other supply, and then it reacted, and then it pushed again and broke that supply. So remember, like, what does this look like? Same as this. You see, on the 15-minute, you're gonna be looking at the same thing on the 1 minute. So price created this liquidity here, this inducement zone, to then we would grab our entry zone. Boom, you could enter on the edge, the 50%, or adjust your entry to make sure you get triggered on this trade. So let me just, sorry guys, this is a lot of information, and like I said before, like as we are doing analysis and trade recaps every day, you're gonna be a pro at this. Like I didn't learn all of this overnight, and this takes time, but you're gonna be learning like all of these setups and like types of entries and everything. Okay, so this is how it would look like. You would set your entry up here, down here, correct? So this would be another confirmation entry, because you don't want to be taking risk entry like here at this 1 minute. You're just reading price action, like, oh, so it just came to mitigate this and it continued pushing up, so it's probably gonna continue going up from here, right? But you don't want to be taking a risk entry because price could just come here and come mitigate something here and then continue down, correct? Or maybe not even, like you would break here and then just do a little push and come down here to maybe mitigate a demand and then continue up. Okay, so like most of, I would say at least 80% of my trades are confirmation entry, and the rest is risk entry. And if you're at the beginning of your learning how to trade, I would, in the beginning at least, stay away from risk entries because it's It's very hard in the beginning because you got to be like extremely certain where price will stop. So if you want to avoid getting a lot of losses in the beginning, you could probably just start taking the confirmation entry every time. Okay, so again, let's go to the next example. Hope you guys are getting this idea. Remember, right? So this we took longs from the sweep of this low. Let me just erase these guys. And this is number 4. Okay. So at this, right? This is another example. Remember that on the liquidity section, we had these equal highs, and the sweep was just to mitigate it something here, and then it gave us a chalk. So now that we price respected the 1 minute, now we have more confluence because, okay, so price is respecting the 15 minute and the 1 minute inside of the 15 minute here. Like the 1 minute would be something inside here, right? So now we have this, like, okay, so we have a confluence, and now we have another confluence because price gave us a chalk down here, correct? And now we have another confluence because price broke these lows too, correct? So we have 3 good reasons to look for shorts from here. Okay, even though everything is bullish, we could just be starting the shift to maybe come somewhere down here to pull back, right, to continue the move up. Okay, so now, so as price mitigated the 1 minute supply, it pushed down and it didn't give you an entry. I was like, oh shit, I missed this because I thought that price would come here and give me the chalk, and it would come back here to give me my entry and go down here. So like it doesn't always happen like that. And again, right, you don't want to just be looking for 1 minute chalks like on a counter trend. Okay, you want to make sure that you are aligned at least with the internal and the swing. I mean, at least the internal structure for you to be taking like 1 minute entries like this. I don't usually take 1 minute entries unless I have a lot of confluences, but that's we can discuss this later. So after we had this push here, and you thought you wouldn't get an entry because price just melted and it broke and it came like down here. But now like we're using multi-time frame analysis, correct? You go to the 15 minute, okay, now we have a chalk here in a breakup structure down here. So here, after we had that break, we could probably be looking like now you would have 2 options. Remember, I think here you would have the risk entry and the confirmation entry, and same here, right? Now you have 2 options. You can take the risk entry if you want, right? It also depends if price came to mitigate something down here. So it's probably better, like I said in the beginning, if you're not sure, if you have any doubt, if price came here to mitigate something down here first, like if you have any doubt, always go with the confirmation entry. So always go, okay? Like, so after we had the chalk and break down here, so this push here created this supply, correct? Remember, because we had a fractal chalk, it created this supply. So when we had the break here, you could possibly be looking to take a risk entry up here And so I'll just break this box. uh, so you could possibly just set your entry here, covering the highs, and then it would be, oops, what did I do? Oh, I think I messed up. Okay, let me put this again. So you would enter here, covering the highs. And so right here, right, you would be entering there, and you could be looking to set your targets to this next demand, correct? So you could either do that if you want, taking risk entry. That means just setting your entry order at the highest point of this move, which would be here. Or if you want, you can wait, because you are like, I'm not sure if you came to mitigate something down here, correct? So like, if you want to be sure, just wait for another confirmation entry. So like, you would have the chalk here, price would come to take your trigger for your entry. Let me just change this so you guys can see. So that's not your entry. So this would be the fresh 1 minute supply, making a supply chain, right? A mitigation here, came back here. This was the extreme of this move. So it came here, respected this 1 minute again, correct? And gave you a chalk. Would be another, sorry, let me, so it gave you another 1 minute chalk here. And this would be your confirmation entry. And you could enter here. Okay, boom. So you can enter like that. So just again, right, for the confirmation entry, because this push created this fresh supply, and you want to see that this will hold, because like, you want to see that we're not just like coming back here to mitigate something here and continue up. So you want to see that on this reversal pattern, this will hold. So you wait for 1 minute, like a change of direction, to then you enter on here. Okay. So that's why our strategy is so powerful, guys, because we are looking at like at the higher time frame, but we are literally entering trades as scalpers. So like, for example here, right? So like, you're entering like inside of this supply area here with a like 3 pip move, and like, maybe you want to get out here for 6 hours, or like maybe take 50% and hold another 50% for like 15. Like, this is insane, you know? Like, and we do this every week, every day, you know? So this is how powerful our strategy is. Okay, so let's continue so this doesn't drag for the crazy long. Okay, so let me, another and last example we're gonna be looking at. So we already took the, let's see here. So we took the longs from here. Boom. Like targeting that highs, and oh, now I need a short one. We took shorts from there, targeting the lows there, right? And now we approached this last area. Okay, so you see, that's why we keep the same. We pretty much trade the same pairs every day, because we want to be looking at the history, and like what price did all this time here. So we already know, because we look at this pair every day, that here we had a sweep of liquidity, right? So price already like swept liquidity here. Uh, so this is a very high probability place that price could possibly hold to continue up from here, because we had this sweep. So price, it's I see it as price already attempted to break this low. Now it pushed up again. Okay. But here, correct? So now price is pulling back down here. So this would be look like this on the 15-minute, and it would look like this on the 1-minute. Okay. So price is going down there. So okay, Marcus, so since we have this high probability zone, that because we had the sweep of liquidity, we could just take a risk entry here, right? So like we could just enter with our price. I mean, we could set our order here, targeting the highs or the next highs, or even breaking these highs here. But what happened? Remember, you need to be looking at both sides of the chessboard. In this case, the charts, right? Price, like you don't want to be looking for risk entries here, even though this is a high probability zone that it might hold, because we already reached this supply zone. So because like this is so extended already, this might be the time that we're gonna be looking to have a deeper pullback, correct? So even though this is a high probability zone and we are pro order flow, we already mitigated this, correct? So we don't want to be uh, taking risk entries here just because of that, correct? So that's one of the rules. So that's why we have everything. All this strategy is on paper, and we don't guess. We don't need to guess anything. Everything's already set up for us to succeed. Okay. So as price is coming down here, so we had this fractal high and then a break. Okay. So what do we want to see? We want to see this demand, this last demand here holding, because if we break this demand, since this already swept liquidity there, so there's no another liquidity to be taken here. So if we break this demand here, we're probably gonna be starting going down. Okay. So what do we want to see inside of this 15-minute zone and on the 1-minute? We want to see another change of direction inside here. The same way we used to take we took the 1-minute trades from these other examples we had. Okay, so as price was coming here, probably we had like a small 1-minute reaction. Price came here, mitigated this 1-minute, and again, right? And in this case, let me do another type of entry that you will probably see. So like as price like came here, it made this like equal lows, and then it came here, boom, mitigated, and we had a V-shaped reaction. A V-shaped reaction that we call on this strategy, the smart money concept, is just like a super nice push, right? Like it's a clean rejection of that price. You always need to think about liquidity and price and orders and money moving the market. Just by having this push up here, like that means that there was a lot of money and orders inside of this zone. That's why it made this push up. Okay. And so now we know we had these equal lows here, the same as this. You see, like as we see the same patterns on the lower time frames and the higher time frames, equal lows, equal highs. So it came here, mitigated, boom, and then we had I'll just use this, make it easier. We had another chalk here on the 1-minute. So We had the equal lows, mitigated, boom, we had another push to the upside. So now we had a rejection of this 1 minute zone. Price didn't break this 1 minute, and he also respected the 15 minute. Okay, so now we have a confirmation entry at this high probability demand, correct? So I'm gonna show you another thing now. So now we have this fresh entry at down here, correct? So now we can be looking to enter like with our longs down here, and then we can then target somewhere like maybe like the next high, or maybe you can hold to see if there's another supply area, but it doesn't matter, right? Because we're already 6 hours, whatever. So okay, price came here. So remember what I said. Since we are pro order flow, like even though the 15-minute chalk is up here, right? So like pay attention because this is important as well. So our 15-minute chalk is up here, which would be all the way up here, correct? Remember, like this is a larger structure, which is this fractal pullback. Let me make this straight. So because we know that this is a high probability zone and we had a 1 minute chalk, so we could be entering on this 1 minute chalk even though we don't have the 15-minute chalk yet. So we are literally just entering early, like expecting that we would have the 15-minute chalk, correct? I hope you guys understand what I mean. Like we are entering like early on the move because we are expecting that price will come here and give us the 15-minute chalk all the way up there. So we would have, first we would see the 1 minute chalk, and then when price comes here, mitigate and going up, we would see this move here that would give us the 15-minute chalk. Okay? So this is a very like nice way of thinking. So you could be looking at to enter here, and then boom. So price just went all the way here. And on this case, it didn't come all the way to give you the entry like down there. So instead it created the inducement to later on, sometime later, to come to mitigate it here. But also price, you would have your entry here, and price could have, let me just erase this. Price could have given you the 1 minute chalk and the 15-minute chalk right away without the pullback, and you would still have your entry down there. You would enter in here because you know this low here is now protected, and this is the last point of this move, and you could probably enter here and take longs, right? Targeting the somewhere down there, up there. Okay, so again, right? Price respect the 1 minute, came here. We had this super crazy now reaction, which is now we had the 1 minute chalk, and now we have the 15-minute chalk. So this is like a super high probability trade that we can just enter on the edge of this candle here that we were gonna see on the live charts. We're covering the lows, and we are targeting for at least a 5-to-1 risk reward. Okay, super cool, super nice. I hope you guys understand this whole concept. We went a little further than I would expect. I thought this would be a shorter one, but I pretty much gave you like many situations and setups that you would probably see on the
real charts. So I think this is great. Uh, I wish I had someone like us here from Neo Trading Club teaching me when I started 4 years ago. This would have saved me so many pain and work, but I'm happy that you guys are learning this. Okay, so again, if you guys have any question, I'm glad to make even further videos explaining this concept. And if there's anything that is unclear about the confirmation entry and risk entry, you let me know. And I'll see you guys on the next time. Thank you so much. The world is populated with billions of people, and everybody is different in their own way. We all think differently and act differently. Some traders are more aggressive and like to enter and exit trades for small wins, and others are okay holding a position longer for bigger wins, knowing that the market could potentially turn against them. For example, trader A would enter 3 positions to gain 5 hours for each trade, and trader B would enter 1 position to make 15 hours total. So which one is the right one? There's no right or wrong. Both can be following the same trading strategy and take different approaches based on their personality. Those characteristics of each person make every market scenario a unique event. So remember when I said that in order to become a better trader, you need to become a better person. You need to find out your own style and how you react to those styles. Don't get me wrong, it's not only about choosing a trading style, but most importantly, working on your mindset to think as a professional trader think. The trading style has nothing to do with entering reckless trades that don't fit the strategy because you have an aggressive approach. Do you know what is called when a person enters trades like they're playing roulette in a casino? Gamble traders. When you place trades without following a strategy and high probable setups, you stop being like the casinos and become an addicted gambler. And do you know what's the worst thing that can happen to addicted gamblers and amateur traders? The lucky win. They will get attached to that behavior that led to the exciting win, and that's the reason why casinos are so profitable. There are 4 main types of styles, and the difference between them are based on the length of time a trader will hold a position. So the scalpers will hold the positions for seconds to a few minutes, day trading seconds to a few hours, swing trader a few days, in a position trading or like the investors a few days to years. All those trading styles can make a trader profitable, and each has its own strengths and weaknesses. Our trading style here at Neo Trading Club was created by getting all the strengths of these styles to get the most return for each trade we take. So different from swing traders, we only need to focus on one pair to see incredible returns on our investment. We use the precision of scalpers and day traders to enter a position with a very small stop loss. And we target larger movements that would be used by swing traders to get massive returns per trade. We believe that risk reward is one of the most important things when trying to achieve consistency. So by using this method, we can ensure that the probability will work in our favor. Keep in mind that this trading style is not easy. In fact, there's no easy path in trading. But I guarantee you that you will get blown away by the results of this strategy, especially if you have used other strategies before. With that being said, we can now start getting to how you can become profitable using our strategy. The answer to that is risk management. In reality, using risk management is actually the only way to become profitable. Trading is just like a business. For example, let's say Joe has an account of $10,000 and he put all the money into buying inventory for his business. If something happens to that inventory and Joe loses all of it, now he wouldn't have money to pay his bills, employees, rent, etc. He would then most likely lose his business. So getting more loans from a bank or friends would also be a bad idea for him because the mentality is still the same. he would probably blow the loan money in another way. The same happens for beginner traders. They literally want to flip their small account into a big account by risking all in one trade. The mentality of hitting a jackpot is what differentiates losers from professional traders. By using risk management, professional traders are able to keep profitable results because they have a proven strategy that gives them an edge in the market in the long run. So how much should you risk? Here in our training club, we have a rule not to risk more than 1% per trade of our trading account. This way, if you have the discipline to learn and follow our teachings, you will become profitable in the long run. There are a few risk-reward calculators you can play with online so you can better understand how strike rate and risk-reward work. Yes, it takes money to make money. You need trading capital so you can generate money. As you all know, trading can be very profitable if you are able to stay committed to your education. Learning will always come before your account size. If one person with a small account and another one with a bigger account start learning to trade together, they're basically starting at the same level. Having a large capital without knowing how to trade won't make any difference in the results. If you are not profitable on a $100 account, having a large account will just make things worse. So your top priority if you're considering trading as a way to wealth is to invest in your education. Being here in our trading club is the best investment you could possibly make, which is to invest in yourself. Also, if you don't have much capital to start trading, don't worry. Luckily, nowadays, there are many trading firms that will give you a lot of capital for you to start investing. These trading firms usually give profitable traders up to $200,000 and the trader gets to keep 90% of the profit. Of course, there's more that goes into that, but that sounds like a good deal to me. What do you think?